Now, if you work in finance, you should already know. Liquidity isn't just one of many risks in banking. It's the risk that can take down a well-capitalized, profitable institution in a matter of days. And yet it remains one of the least understood, most underestimated areas of financial risk management. That's exactly why the industry portal created this liquidity management course. This course is a comprehensive, professionally designed program that goes far beyond the basics. This isn't just a walkthrough of regulatory ratios or a few comments on cash buffers. This is a full deep dive into how liquidity works, why it matters, and how to manage it with confidence, precision, and foresight. Across 20 in-depth sessions, you'll be guided through every key element of liquidity risk, from daily treasury operations and regulatory compliance, to stress testing, cross-border management, climate risk, and the impact of emerging technologies like AI and digital currencies. You'll learn about tools like funds transfer pricing, liquidity forecasting, and contingency funding plans, not just in theory, but in the context of real banking operations with examples that make sense. Whether you're in treasury, risk, finance, regulation, or you're just looking to break into the field, this course will give you the knowledge and strategic understanding to speak the language of liquidity at the highest level. The course is global in scope, with a strong focus on UK and EU frameworks, and it's structured to help you not just understand liquidity, but to lead on it. So if you're ready to go beyond surface level knowledge and build real expertise in one of the most mission critical areas of banking, this is the course for you. Liquidity is a risk you can't afford to ignore, but it's also a skill you can master when you learn from industry experts. I hope to see you inside the course. Hi there, and welcome to this comprehensive course on liquidity management brought to you by the industry portal. Whether you're a treasury analyst, a risk professional, a finance manager, or a regulator in training, you're in the right place. Liquidity is one of the most critical, complex, and fast-moving risks in banking. And managing it well is what separates stable, resilient institutions from those that falter under stress. Over the next 20 sessions, you'll gain a complete end-to-end understanding of liquidity risk, what it is, how it behaves, how to measure it, and most importantly, how to manage it effectively across different environments, business models, and regulatory regimes. Now, this course is built for finance professionals. It's global in scope with a particular focus on the UK and EU frameworks, and it covers both the technical and strategic aspects of liquidity, from modelling and metrics to governance, culture, and future trends like AI and CBDCs. So let's take a quick look at what you can expect to take away from this course. Firstly, you'll obtain a solid grounding in liquidity risk concepts, including the role of the liquidity coverage ratio, the net stable funding ratio, and internal stress testing. We'll deep dive into practical tools like funds transfer pricing, buffer management, contingency funding plans, and ILAAPs. You'll obtain a clear view of regulatory expectations from the PRA, ECB, EBA, and Basel Committee, and how to navigate them effectively. You'll obtain a better understanding of how treasury, risk, and finance functions work together to manage liquidity in real time. You'll gain insight into how climate risk, ESG, and digital transformation are reshaping the liquidity landscape and what banks must do to stay ahead. And perhaps most importantly, we'll take a look at the mindset, behaviours, and communication skills that make a truly effective liquidity professional. Now, each session in this course is designed to be self-contained, but builds on the previous session, creating a cohesive narrative from start to finish. You'll hear real-world examples, structured explanations, and thoughtful reflections that help connect regulation to reality, theory to practice. By the end of this course, you'll not only understand liquidity risk, you'll be ready to lead it. You'll be better equipped to assess funding strategies, challenge risk assumptions, contribute to regulatory submissions, and make informed decisions in high-pressure situations. This is not just a technical training course. It's a strategic education for professionals who want to think, speak, and act confidently in the world of liquidity risk. So, wherever you're starting from, whether you're building your foundation or sharpening your expertise, this course will take your liquidity management knowledge to the next level. So let's get started. I'll see you in the next video. Before anything else, I want to start by laying out one simple truth. A bank can be profitable, well capitalized, and appear completely sound. But if it runs out of liquidity, even briefly, it can collapse almost instantly. That's how critical liquidity is. In this first session, we're going to explore what liquidity actually means, why it's so fundamental to the functioning of banks, and how careful management of liquidity can mean the difference between stability and failure. We'll also introduce the key concepts that underpin liquidity practices today and explain why this topic is at the center of every serious risk management conversation in finance. So let's begin by breaking down what liquidity means in banking terms. Now, in its most fundamental sense, liquidity is about a bank's ability to meet its financial obligations as they fall due, without suffering losses that are unacceptable or unsustainable. So those obligations can include anything from paying out customer withdrawals to meeting loan disbursement commitments, settling debts to other financial institutions, or fulfilling clearinghouse requirements. In essence, liquidity is about cash, or assets that can be very quickly turned into cash. It's not about whether the bank is profitable or whether it's got a strong capital position. It's about whether it can pay its bills today, tomorrow, and in the near future, even under stress. You see, banks operate in a unique business model where they transform maturities. In other words, they take in short-term deposits, so funds that customers can pull out any day, such as the cash they have in their current accounts, and banks use those funds to lend long-term, like issuing 5-year loans or 25-year mortgages. Now, that gap between the short-term liabilities and long-term assets creates what we call a maturity mismatch. Now, this mismatch is profitable to a bank because banks earn a spread between the cost of short-term funding and the yield on long-term loans. But it also creates a vulnerability. If those short-term liabilities are suddenly withdrawn or can't be refinanced, the bank has to scramble to find cash. This is where liquidity risk arises. Liquidity risk is essentially the risk that a bank won't be able to meet its obligations when they're due because it doesn't have enough cash or can't convert assets into cash quickly enough without heavy losses. And when liquidity risk materializes, it happens fast. Now, unlike credit risk, which plays out over months or years, or market risk, which can vary daily, liquidity risk can cripple a bank in a matter of hours. Now, this immediacy is what makes it so dangerous and so central to how banks are regulated and run. So let's take a moment to illustrate this. Now, imagine a hypothetical bank. We'll call it Industry Bank. Now, Industry Bank has a large book of residential mortgages, which generates steady income over the next 15 to 20 years because customers continue to pay off their mortgages and their respective interest payments. Now, most of its funding comes from retail and corporate deposits. For years, Industry Bank has been profitable. It passes all of its regulatory capital requirements. Now, from a balance sheet perspective, it looks healthy. But now imagine a sudden rumour spreads, maybe online, maybe through financial press, that Industry Bank is facing trouble with one of its loan portfolios. Within a day or two, a significant portion of its depositors start to withdraw their funds just to be safe. After all, there's nothing stopping them from doing so. Now, if Industry Bank doesn't have enough liquid assets on hand or quick access to borrowing, it may find itself unable to meet those withdrawal requests. It may need to start selling off assets quickly, at poor prices. Now, confidence erodes further. More withdrawals follow. A self-reinforcing cycle begins. And within days, Industry Bank faces a full-blown liquidity crisis. Now, this kind of scenario isn't just theoretical. We've seen it in real life many times. In fact, history is full of examples where solvent banks, meaning they had more assets than liabilities, failed simply because they didn't have enough liquidity to survive a short-term shock. Northern Rock in the UK, for instance, failed in 2007 because of a severe liquidity issue, even though its long-term asset base was strong. More recently, Silicon Valley Bank in the United States experienced a devastating run that unfolded in less than 48 hours as corporate clients rapidly withdrew deposits amid concerns about interest rate exposure and asset valuations. The bank could not meet the outflows and collapsed. Now, these events serve as a stark reminder that liquidity is a real-time issue. It's not about what the balance sheet says in the long run. It's about whether the bank can meet its cash needs right now. So what does this mean for liquidity management? It means that banks need to actively plan for liquidity demands across multiple time horizons. They need to be able to meet daily settlement obligations and customer withdrawals, but also survive a prolonged stress event where funding dries up, where markets become dislocated and confidence evaporates. Now, this involves having access to high-quality liquid assets. Assets like government bonds or central bank reserves that can be quickly sold or pledged without taking large losses. It also involves being able to predict how cash will flow in and out of the bank under different conditions. Now, one of the most important concepts in liquidity risk management is the idea of the liquidity buffer. The liquidity buffer, or liquid asset buffer, whatever you prefer, is a stockpile of unencumbered, high-quality liquid assets that the bank can draw on in times of stress. So think of it like a reserve of emergency cash. Regulators around the world now require banks to maintain a minimum level of such assets under rules like the liquidity coverage ratio, which we'll discuss in depth in a future session. But beyond regulation, banks themselves have developed internal liquidity risk frameworks, which includes models and limits that govern how they manage their daily and long-term liquidity positions. So let's now briefly touch on how banks actually go about managing liquidity. The central function involved is the Treasury department. Now, Treasury teams oversee daily cash positions, ensure funding sources are diversified, and execute liquidity plans. They work hand in hand with risk management functions, which conduct liquidity stress testing, scenario analysis, and contingency planning. Now, together, these teams are responsible for identifying liquidity gaps and ensuring that the bank has access to cash at all times. Now, banks also make use of what's known as funds transfer pricing, or FTP for short. Now, this is an internal pricing system that attributes a cost to liquidity. If one part of the bank wants to use funding, for example, to issue a loan, it will pay a notional liquidity cost to Treasury. Now, this internal pricing encourages business lines to think carefully about their use of funding and ensures the true economic cost of liquidity is built into decision making. Now, at the same time, liquidity risk is heavily influenced by external market dynamics. Banks rely on capital markets to raise funding, whether through issuing bonds, accessing repo markets, or borrowing from other banks. If markets freeze or counterparties lose confidence, those sources can disappear. That's why liquidity management also involves careful monitoring of market signals, bid-ask spreads, haircuts, counterparty behavior, and overall investor sentiment. Now, in addition to managing their own internal liquidity, banks must comply with a growing body of regulatory requirements. These include quantitative rules such as the liquidity coverage ratio and the net stable funding ratio, as well as qualitative frameworks like the Internal Liquidity Adequacy Assessment Process, or ILAAP for short, which applies in the UK and EU. Now, these frameworks require banks to show that they understand their liquidity profile, have appropriate governance in place, and can respond effectively to stress scenarios. Now, we'll be diving into each of these regulations in future sessions. So why has liquidity management become so central to modern banking? The answer lies in the lessons of the past. Time and time again, financial crises have shown that liquidity failures are contagious. When one bank fails to meet obligations, Counterparties get nervous, withdrawals increase, market funding dries up, the failure spreads. That's why regulators and central banks place such a strong emphasis on liquidity buffers, funding diversity, and its ability to withstand shocks. It's also why banks invest in technology, analytics, and modelling capabilities to forecast cash flows with increasing precision. But liquidity management isn't just about defensive measures. It's also about enabling growth. A bank that has robust liquidity controls can take advantage of opportunities. It can lend more, invest more, and move quickly without constantly worrying about survival. So in that sense, liquidity management is not just a risk discipline, it's a strategic one. When managed well, it becomes a source of strength, not just a safeguard. And for all of those cost-conscious finance professionals, let's not forget that liquidity also has a cost. Holding high-quality liquid assets often means holding assets with low yields. Funding long-term projects with stable sources may be more expensive than using short-term funding. Now, that trade-off between safety and profitability is a central tension in banking. Liquidity costs must be balanced with business needs. Part of good liquidity management is understanding that cost and pricing it appropriately. It's not about eliminating risk, but about managing it intelligently. Throughout this course, we'll explore all of these themes in depth. We'll look at how different banks approach liquidity management, how regulators assess liquidity, and how stress testing and contingency planning work in practice. We'll examine how emerging risks like digital disruption, climate change, and geopolitical shifts are reshaping liquidity dynamics. And we'll end with a forward-looking view on how technology, particularly artificial intelligence and the rise of central bank digital currencies, may impact liquidity frameworks in the years ahead. For now, though, the key takeaway from this session is that liquidity is not optional. It's not just another line item on a risk report. It is essential. A bank can survive credit losses. It can survive market swings, but it cannot survive a liquidity freeze. That's why liquidity management sits at the heart of everything a modern bank does. In our next session, we'll take a closer look at how liquidity management has evolved over time. We'll trace its history through past crises, from the early bank runs of the 19th century to the global financial crisis of 2008, and the more recent turmoil in 2023. Now, this historical lens will help us understand why today's rules and frameworks exist, and how the past continues to shape the future of liquidity management. I'll see you in the next session. To really understand how liquidity risk management has become what it is today, we need to take a step back and look at where it all began. In this session, we'll explore the history of banking liquidity through the lens of past financial crisis and pivotal moments. We'll see how every major banking failure has left a permanent mark on regulation, supervision, and how banks approach liquidity. By tracing this evolution from the bank runs of the 19th century to the modern-day collapses of Silicon Valley Bank and Credit Suisse, we'll reveal how each chapter in financial history has pushed liquidity higher up the agenda for banks and regulators alike. So let's start with the earliest instances of liquidity failure, the classic bank run. In the 19th century, banks operated in a fragile financial environment with few protections and limited oversight. Depositors would queue outside banks at the first sign of trouble, driven by fear that their money might not be there tomorrow. Now, these runs were often self-fulfilling. Even if a bank was financially sound, the mere act of people withdrawing their funds in their masses could cause it to collapse. Now, one of the earliest recorded examples was the 1866 panic in London, where the collapse of Overend, Gurney and Company, a major wholesale discount house, caused panic across the British banking sector. Depositors rushed to withdraw their savings from numerous banks, many of which were unable to meet the demand for cash. Now, that panic set a crucial precedent. It forced the Bank of England to step in and act as what we now call a lender of last resort, a concept formalised by Walter Bagehot, a 19th century economist whose thinking still underpins central bank doctrine. Bagehot's guidance was simple but powerful. In times of panic, central banks should lend freely to solvent institutions against good collateral and at a penalty rate. This wasn't about rescuing failing banks. It was about stopping panic from spreading to healthy ones. His principle has shaped central bank responses to liquidity crisis ever since. Now moving to the United States. The early 20th century saw repeated and devastating bank runs. Without a central bank at the time, i.e. before the Federal Reserve was created in 1913, banks relied on informal arrangements and private networks to try to stem crisis. The Panic of 1907 is particularly notable. It started with the collapse of a speculative scheme to corner the copper market and escalated rapidly, spreading fear throughout New York's financial system. Several banks and trust companies experienced runs. Confidence collapsed. And with no central bank in place, it was left to private bankers, most famously JP Morgan, to orchestrate a bailout. Now Morgan gathered leading bankers in his library and effectively locked them in until they agreed on a rescue package to inject liquidity into the system. Now while the panic was eventually contained, it exposed how vulnerable the system was without a central mechanism to provide emergency liquidity. It also sparked the political momentum to create the Federal Reserve, which was established just 6 years later. Now, the Fed's creation marked a turning point in how liquidity was managed. With a central authority in place, banks now had a backstop, someone to turn to if market funding dried up. But this wasn't the end of liquidity-driven crisis. Just 2 decades later, the Great Depression delivered another blow. In the early 1930s, over 9,000 banks in the US failed, many due to classic liquidity runs. Even though some of those banks may have been solvent, they couldn't meet mass withdrawal requests. Now, what made this different was the scale. Unlike previous episodes, this wasn't just a handful of institutions. It was systemic. People had lost faith in the banking system altogether. To stop the hemorrhaging, the US government introduced a landmark reform: deposit insurance. When the Federal Deposit Insurance Corporation, or FDIC for short, was created in 1933, it guaranteed that depositors would be repaid up to a certain amount, even if their bank failed. Now, this dramatically reduced the likelihood of retail bank runs. If depositors knew their money was safe, they had little reason to panic. The UK and other countries followed with similar schemes in the decades that followed. Now, from a liquidity perspective, this was a game changer. Deposit insurance became the first major structural defense against liquidity runs. And for the next several decades, the global banking system enjoyed a period of relative calm. Banks operated within tightly regulated environments, often with restrictions on interest rates, capital flows, and the types of business they could engage in. The focus was on stability rather than innovation, and liquidity management during this time was relatively straightforward. Banks kept higher levels of reserves, often as a regulatory requirement, and funding markets were more predictable. But this stability wouldn't last. In the 1970s and 1980s, inflation, deregulation, and globalization began reshaping the financial world. Banks increasingly turned to wholesale funding markets, raising money not just from depositors, but from other banks, investment funds, and global money markets. Now, this shift created a new form of liquidity risk. Wholesale lenders were far more sensitive to market sentiment than retail depositors. If they sensed any weakness, they could pull funding overnight. And they did. One of the earliest warnings came in 1984 with the failure of Continental Illinois, then the 7th largest bank in the US. Now, although its underlying problem was credit-related, bad loans to energy firms, the real killer was liquidity. Once investors and counterparties lost confidence, the bank faced a rapid withdrawal of wholesale funding. Now, in a matter of days, it was effectively shut out of the market. The government had to step in with a $4.5 billion bailout, the largest of its kind at that time. Now, it was during this crisis that the term too big to fail entered the mainstream. And the lesson was clear. a liquidity crisis can bring down even a large, well-capitalized institution if confidence evaporates. Now, despite this warning, liquidity risk remained something of a secondary concern through the 90s and early 2000s. Regulators were primarily focused on credit and market risk, and the Basel I and Basel II frameworks reflected that. Now, these accords focused on capital, i.e. how much a bank needs to absorb losses, but said very little about liquidity. Now, banks were left to manage liquidity according to their own policies, guided by broad principles, but without detailed global rules. Many developed their own internal models and risk appetites, but practices varied widely across institutions and countries. Now, this gap became painfully obvious in 2007. The global financial crisis, which began in the US subprime mortgage market, quickly spiraled into a full-blown liquidity meltdown. Banks and investors realized that assets they thought were safe and liquid, like mortgage-backed securities, were anything but. Confidence vanished almost overnight. Funding markets froze. Even banks with strong capital positions couldn't refinance their short-term obligations. Northern Rock in the UK became one of the first casualties. It had relied heavily on wholesale markets to fund long-term mortgage lending. Now, when those markets dried up, it had no fallback. The images of customers queuing outside Northern Rock branches marked the first bank run on a UK institution in over a century. From there, the crisis escalated. In the US, Bear Stearns collapsed in early 2008, rescued only by a government-brokered sale. Lehman Brothers wasn't so lucky. When it filed for bankruptcy in September of that year, the shockwaves rippled through the entire global financial system. Suddenly, no one wanted to lend to anyone. Interbank markets froze, asset prices collapsed. Even institutions that had done nothing wrong found themselves unable to fund their operations. The fear was universal. What if I lend to you today and tomorrow you're gone? Now, what made this crisis different was its speed and scale. It exposed how interconnected the system had become and how little resilience there was in terms of liquidity. Banks were over-reliant on short-term wholesale funding. They held too few truly liquid assets. Their contingency plans didn't account for markets shutting down completely. And worst of all, they underestimated how quickly confidence could vanish. Now, in the aftermath, regulators acted decisively. The Basel Committee introduced Basel III, a sweeping set of reforms designed to strengthen bank resilience. And for the first time, liquidity was given equal footing with capital. Two new global standards were introduced: the Liquidity Coverage Ratio, or LCR for short, and the Net Stable Funding Ratio, NSFR for short. The LCR required banks to hold enough high-quality liquid assets to survive a 30-day market-wide stress event. The NSFR ensured banks had stable funding for their long-term activities. Now, these rules changed the game. Liquidity was no longer just an internal risk to be managed. It became a regulated obligation. In Europe, regulators introduced even more stringent measures. The European Banking Authority and the European Central Bank implemented detailed frameworks, including the Internal Liquidity Adequacy Assessment Process, or ILAAP for short. Banks were now required not just to hold buffers, but to explain and justify how they managed liquidity risk. This included documenting their risk appetite, describing their contingency funding plans, and proving that senior management understood the risks and approved the strategies. In the UK, the Prudential Regulation Authority followed a similar path, incorporating liquidity into the wider Supervisory Review and Evaluation Process, or SREP for short. For the next decade, these reforms reshaped banking. Liquidity risk management became more sophisticated. Banks invested in better data, analytics, and governance. Treasury functions became more centralized and more powerful. Stress testing evolved, becoming a core tool not just for regulators, but for internal planning. Liquidity buffers increased significantly, and the lessons of 2008 remained fresh in everyone's mind until the next big test arrived. And that test came in 2020 with the outbreak of the COVID-19 pandemic. Financial markets faced an unprecedented shock. As economies locked down, markets panicked. Corporates rushed to draw down credit lines. Investors fled to cash. Some markets, including even parts of the US Treasury market, became dysfunctional. Once again, liquidity was under pressure. But this time, the outcome was different. Banks held more high-quality liquid assets than ever before. Central banks acted swiftly, injecting vast amounts of liquidity through emergency lending programs and asset purchases. Regulators temporarily relaxed liquidity rules, allowing banks to dip into their buffers. And despite the turmoil, most banks stayed afloat. The response to COVID-19 was a validation of the post-2008 reforms. Banks were better prepared. Liquidity plans were more robust. Stress scenarios had accounted for sudden demand spikes. And importantly, the coordination between banks, regulators, and central banks was stronger. Liquidity risk had finally become something that the industry truly understood and respected. But history doesn't stop. In 2023, new reminders emerged. Silicon Valley Bank collapsed after rapid withdrawals by tech clients triggered by fears over interest rate risk and an asset liability mismatch. Its funding model, relying on a concentrated, sophisticated depositor base, proved fatally fragile. Credit Suisse followed shortly after, as confidence in its future evaporated amid a string of reputational hits and risk management missteps. Though different in their specifics, both cases underscored an old truth. Liquidity crises happen fast, and once confidence goes, it's almost impossible to get it back. So what does all of this history teach us? Well, first, that liquidity risk is nothing new. It's been a threat to banks for over 150 years. Second, that each crisis brings new lessons. Whether it's the need for central banks, the value of deposit insurance, or the importance of high-quality liquid assets, each reform has built on past failures. And third, that complacency is dangerous. Just because liquidity risk has been quiet for a while doesn't mean it has disappeared. In fact, it's often when things seem calm that the seeds of the next crisis are sown. For today's financial professionals, understanding this history isn't just academic, it's practical. It explains why regulations are the way they are. It clarifies why certain buffers exist, why stress testing is essential, and why risk managers always ask, what if? And most of all, it reinforces the idea that managing liquidity is about preparing for the unexpected. The past shows us that the unexpected happens more often than we'd like to admit. In our next session, we're going to build on this historical foundation by diving into the different types of liquidity risk that banks face today. We'll break down the distinction between funding liquidity risk and market liquidity risk, explore contingent liquidity exposures, and introduce some of the key indicators banks use to monitor risk in real time. By the end of the next session, you'll have a clear framework for identifying the various ways in which liquidity risk can manifest and how banks keep it under control. I'll see you in the next session. Now that we've explored the historical journey that shaped today's liquidity frameworks, it's time to shift gears and focus on the nature of liquidity risk itself. In this session, we'll break down the different types of liquidity risk that banks face, understand how they arise, and explore how these risks can interact and intensify under stress. We'll look at the traditional categories: funding liquidity risk and market liquidity risk. But we'll also go further to cover contingent liquidity risk, intraday liquidity risk, and structural risks that build up over time. By the end of this session, you'll have a clear mental map of the various liquidity risks that exist within a bank and how professionals identify and assess them. So let's start with the most common and frequently discussed type: funding liquidity risk. Now, this is the risk that a bank will not be able to meet its obligations as they fall due because it cannot obtain new funding or convert its assets to cash in time. Now, these obligations could include repaying maturing deposits, making loan disbursements, settling trades, or fulfilling other financial commitments. What's important to note here is that this is not about whether the bank is insolvent. It's about whether it has enough accessible cash or borrowing capacity to bridge the gap between cash outflows and inflows in a timely manner. Funding liquidity risk typically arises from a mismatch in timing between the maturity of a bank's liabilities and the maturity of its assets. Now, this is the classic maturity transformation risk. Banks borrow short and lend long. A common example is a bank that funds itself with short-term deposits or wholesale borrowings and uses those funds to provide long-term loans or mortgages. Now, under normal conditions, this model works well. Depositors don't all withdraw at once, and markets function efficiently. But when confidence drops or funding markets freeze, the liabilities may fall due much faster than the assets can be liquidated or refinanced. And that timing gap creates the pressure point. Now, the main drivers of funding liquidity risk can be grouped into a few key categories. First, there's the concentration of funding sources. So if a bank relies too heavily on one segment, say a small number of corporate depositors or a single wholesale market, a problem in that segment can lead to an immediate and significant funding shortfall. Second, there's the term structure of liabilities. A bank that has to roll over large amounts of funding every few days is inherently more exposed than one with longer dated liabilities. Third, there's the behavioural nature of depositors and lenders. Not all funding is equally sticky. Retail deposits covered by deposit insurance tend to be more stable than large uninsured corporate deposits. But even insured deposits can be withdrawn quickly in today's digital environment, especially if public sentiment shifts. And finally, the health of the broader market matters. Even if a bank is fundamentally strong, it can struggle to raise funding if the entire market is under stress. Next, let's look at market liquidity risk. Now, this refers to the risk that a bank will be unable to sell assets or raise funds through market transactions without incurring significant losses due to poor market conditions. So in simple terms, it's about whether the bank's assets are actually liquid when it needs them to be. Now, this type of risk is particularly dangerous because it often appears during periods of market volatility, when asset prices are falling and bid-ask spreads are widening. Now, in such environments, even high-quality assets may struggle to find buyers. Take, for example, a bank that holds a large portfolio of corporate bonds as part of its liquidity buffer. Now, in stable markets, those bonds can be sold quickly and at close to face value. But during a crisis, buyers may demand deep discounts or disappear altogether. Now, this forces the bank to either accept fire sale prices, which hits its capital, or find alternative ways to raise cash. Now, during the global financial crisis, banks learned this lesson the hard way. Mortgage-backed securities, which were once considered highly liquid, became effectively unsellable. As a result, banks that had assumed those assets could be used for liquidity found themselves trapped. Now, several factors influence market liquidity risk. These include the type of asset, the size of the position, the depth of the market, and the level of stress in the system. Government bonds issued by stable economies like US Treasuries or German Bunds are generally the most liquid and form the backbone of liquidity buffers. On the other hand, structured products, lower-rated corporate bonds, or niche investments can become extremely illiquid under stress. Banks need to continuously reassess the market liquidity of their holdings, not just under normal conditions, but in adverse scenarios. Now, it's crucial to understand that funding liquidity risk and market liquidity risk are deeply interconnected. When a bank is under funding pressure, it typically turns to its assets to raise cash. But if those assets can't be sold or can only be sold at steep losses, the funding problem worsens. Now, this dynamic played out repeatedly in 2008 and again in 2023. Liquidity management, therefore, must account for both sides of the balance sheet: the reliability of funding and the convertibility of assets. Now, in addition to these two core risks, banks also face what is known as contingent liquidity risk. This refers to the potential for off-balance sheet commitments to suddenly become on-balance sheet cash demands. The most obvious example is undrawn credit lines. A bank might provide a corporate client with a revolving credit facility. Now, under normal conditions, the client may not draw it, but in a downturn or a crisis, clients often draw down these facilities as a precaution, turning a potential exposure into an immediate funding need. Now, similarly, standby letters of credit, guarantees, or commitments can all crystallize into real cash obligations. Another form of contingent risk comes from derivatives contracts. If a bank's credit rating is downgraded, it may be required to post additional collateral to counterparties under standard credit support annexes. Now, these sudden collateral calls can be substantial and may not be easily anticipated. The nature of contingent liquidity risk is that it can appear suddenly and without much warning. Banks mitigate this by identifying all contingent exposures, estimating their likely drawdown rates in stress scenarios, and holding sufficient liquidity to cover them. Now, regulators often require conservative assumptions. For example, in a severe stress test, banks may assume that 100% of corporate clients draw down their committed lines or that all guarantees become payable. Now, these assumptions are harsh, but necessary to ensure that banks can survive extreme but plausible events. Now, there's also intraday liquidity risk. While less commonly discussed, this is a very real issue, particularly for banks that are active in payment and settlement systems. Intraday liquidity risk is the possibility that a bank cannot meet its payment obligations as they arise during the day, even if it can meet all obligations by the end of the day. The reason this matters is that financial systems work on a just-in-time basis. Large value payments settle in real time. If a bank fails to send a payment when expected, it can disrupt markets, damage relationships, or trigger penalties. Delays in incoming payments can create timing mismatches. Technical failures, operational bottlenecks, or unexpected payment demands can all push a bank into temporary shortfalls. Now, to manage this risk, banks monitor expected intraday flows, maintain real-time dashboards, and may hold dedicated intraday buffers. Now, some central banks provide intraday credit, allowing banks to smooth their payment profiles. Regulatory attention to this risk has grown, particularly in the UK, where the Bank of England expects major firms to manage intraday liquidity explicitly, not just as part of broader funding. Now, beyond these identifiable categories, there's a broader concept of structural liquidity risk. Now, this is the risk that a bank's business model or funding profile makes it inherently vulnerable over time, even if there's no immediate stress. For instance, a bank that funds itself mostly with short-term wholesale borrowing and invests heavily in long-dated illiquid loans may be exposed to rollover risk. It might pass every liquidity metric today, but it lives on a tightrope, constantly relying on markets being open tomorrow. Structural risk also arises from poor diversification, so relying too heavily on a single currency, a region, or customer segment, for example. If something changes in that segment, the bank could be caught off guard. This is where the concept of the net stable funding ratio comes into play. The NSFR was designed to capture structural mismatches by requiring banks to fund long-term assets with stable liabilities. It forces banks to consider not just the next 30 days, but the next 12 months and beyond. We'll explore this ratio in more depth in a future session, but it's worth noting here as a response to the type of structural risks that often go unnoticed until a crisis hits. So how do banks actually monitor all of this in practice? It starts with a robust liquidity risk framework. Banks use a combination of metrics, models, and expert judgment to identify and track each type of risk. For funding liquidity, they maintain cash flow projections, often called maturity ladders, that show expected inflows and outflows over various time buckets. Now, these can range from same day to 1 year or longer. Gaps in these projections help identify when the bank might run short of cash and by how much. For market liquidity, banks categorize their assets by liquidity characteristics. They assess which can be sold quickly, at what haircut, and under what market conditions. Stress scenarios are then applied to see how these assumptions hold up in turbulent markets. This helps determine how reliable the bank's buffer actually is. Contingent risks are captured through inventory-style mapping of off-balance sheet exposures. The bank estimates drawdown or crystallization probabilities and applies those assumptions in stress testing. Derivative exposures are monitored for collateral requirements and potential increases in volatility-driven margin calls. Intraday risk is tracked through real-time payment system monitoring. Banks map expected payment flows and build models to assess timing mismatches, ensuring that payment obligations can be met even under pressure. Some institutions go further by integrating this into their Treasury dashboards, so they can make intraday decisions based on the up-to-the-minute liquidity positions. Now, to support all of this, governance is critical. Liquidity risk teams, often within the Treasury or risk management functions, produce daily and weekly reports, monitor key indicators, and escalate issues when triggers are breached. Asset liability committees, or ALCOs for short, meet regularly to review liquidity positions and strategies. In larger institutions, dedicated liquidity risk committees may exist, supported by teams that model scenarios, backtest assumptions, and interface with regulators. And speaking of regulators, they too classify liquidity risk in these categories and expect banks to demonstrate how they're managing each one. For example, the liquidity coverage ratio focuses primarily on short-term funding liquidity under stress. The net stable funding ratio addresses structural liquidity. The ILAAP covers all of the above, requiring banks to provide evidence of how they identify, measure, manage, and monitor every relevant liquidity risk across time horizons and business lines. In today's environment, this is not a box-ticking exercise. Regulators expect banks to integrate liquidity risk deeply into their strategic and operational thinking. That includes embedding liquidity costs through internal transfer pricing mechanisms, aligning liquidity planning with business growth, and ensuring that senior management understands the implications of liquidity constraints on overall performance. To sum up this session, liquidity risk is not a single concept. It's a spectrum of interconnected risks, each with its own triggers, transmission channels, and mitigation strategies. Funding liquidity risk is about whether the bank can raise cash. Market liquidity risk is about whether its assets can be sold. Contingent risks are about off-balance sheet obligations that can materialize suddenly. Intraday risks are about payment timing. And structural risks reflect the long-term sustainability of the bank's business model. Understanding these categories is essential for managing them effectively. It's not enough to monitor one or two metrics. A modern liquidity framework must be comprehensive, forward-looking, and adaptive. It must reflect both normal and stress conditions. And it must allow the bank to survive, not just in theory, but in practice, under a wide range of plausible and extreme events. In our next session, we'll build on this risk taxonomy by exploring how banks structure their internal teams and governance processes to manage liquidity day by day. We'll examine the roles of Treasury, risk, finance, and the board, as well as the systems and data infrastructure needed to support effective decision-making. We'll also look at how firms organize themselves across entities and regions to manage liquidity holistically. If you've ever wondered who actually keeps a bank liquid and how they do it, you won't want to miss what's coming next. I'll see you in the next session. Now that we've built a clear understanding of the different types of liquidity risk that banks face, the next logical step is to examine how banks structure themselves to manage these risks effectively. In this session, we're going to explore the organizational side of liquidity risk management. We'll look at the key roles played by different teams within a bank, how responsibilities are divided, and how governance is structured to ensure accountability, escalation, and decision-making. We'll also touch on the systems and data infrastructure that enable these teams to do their jobs and how international banks coordinate liquidity across multiple jurisdictions and legal entities. By the end of this session, you'll have a detailed understanding of what a robust liquidity management framework looks like in practice and what it takes to make that framework work day in, day out. So let's begin with the core functions. At the heart of liquidity management is the Treasury function. Treasury is responsible for the day-to-day management of the bank's cash, funding, and liquidity buffers. It ensures the bank has enough cash to meet obligations, plans ahead for funding needs, and manages the portfolio of high-quality liquid assets. Treasury acts as the central hub for managing liquidity risk in real time. It monitors balances, executes market transactions, and liaises with counterparties and central banks. In many banks, Treasury also owns the funds transfer pricing mechanism, which allocates liquidity costs across the organisation, a key topic we'll cover in more depth in a future session. Closely supporting Treasury is the Liquidity Risk Management team. Now, this function may sit within the broader Treasury team or risk department, or exist as a standalone specialist team. Its role is to provide independent oversight of the bank's liquidity position, policies, and risk appetite. It develops and calibrates liquidity risk metrics and limits, performs scenario analysis, and designs stress tests. It also plays a major role in regulatory engagement, producing parts of the ILAAP, responding to supervisory reviews, and ensuring compliance with local and global liquidity regulations. Now, while Treasury is responsible for managing liquidity risk ensures that Treasury operates within a well-defined risk framework. Then there's finance, which plays a supporting but crucial role. Finance teams provide the data needed for liquidity forecasting, things like actuals and expected cash flows, maturity profiles, and behavioural assumptions. Finance may also own the balance sheet strategy, working with Treasury and risk to align liquidity with capital planning and earnings objectives. In some institutions, finance are involved in liquidity reporting, particularly regulatory returns submitted to authorities like the PRA in the UK or the European Central Bank. Another key player is technology. Managing liquidity risk today is impossible without accurate, timely data. Technology teams build and maintain the infrastructure needed for real-time liquidity dashboards, forecasting models, risk reporting engines, and scenario simulation tools. They ensure that source systems feed clean, reconciled data into the liquidity management process. They also support automation, which is increasingly important as banks handle more complex stress scenarios, greater regulatory granularity, and shorter reporting timelines. Overseeing all of these functions is governance. At the top sits the board of directors, which ultimately owns the bank's risk appetite, including its tolerance for liquidity risk. The board approves key policies, reviews liquidity reports, and ensures that management has the resources and capabilities to manage risk appropriately. In larger banks, the board may delegate this responsibility to a risk committee, which meets regularly to oversee all material risks, including liquidity. Beneath the board is the executive management, typically through a dedicated Asset and Liability Committee, or ALCO for short. ALCO is the central decision-making body for liquidity risk. It brings together Treasury, risk, finance, and business units to review the bank's liquidity profile, approve funding strategies, set or adjust limits, and respond to changes in market conditions. ALCO usually meets monthly, but during periods of stress, it may convene weekly or even daily. Supporting ALCO may be a liquidity risk committee, particularly in larger or more complex firms. This committee focuses specifically on liquidity issues, reviewing risk metrics, analysing stress test results, and recommending actions. It provides a forum for escalation and challenge, ensuring that decisions are well informed and consistent with the bank's risk appetite. Some banks also establish working groups or forums focused on specific aspects of liquidity, such as contingency funding plans, FTP governance, or regulatory change implementation. To ensure accountability, most banks use a 3 lines of defence model. The first line of defence consists of business units and Treasury, who are responsible for managing liquidity on a day-to-day basis within the approved risk framework. The second line includes risk and compliance, who oversee and challenge the first line, ensuring policies are followed and limits are respected. And the third line is internal audit, which independently assesses the effectiveness of the liquidity risk framework and governance arrangements. This model helps ensure that liquidity risk is managed consistently with appropriate checks and balances. In terms of systems and infrastructure, modern liquidity management depends on a suite of tools. At the core is a liquidity reporting engine which consolidates data from across the bank to produce daily metrics, things like the liquidity coverage ratio, intraday positions, and maturity mismatch reports. Now, these systems often feed into dashboard platforms, allowing Treasury and risk teams to monitor liquidity in near real time. Now, many banks also use forecasting tools to project future liquidity positions under different scenarios. Now, these tools incorporate assumptions about cash flows, customer behavior, market conditions, and regulatory requirements. Some banks go further by integrating machine learning or predictive analytics, allowing for dynamic stress testing and real-time insights into emerging risks. Another critical system is the funds transfer pricing engine, which calculates the internal cost of funding for each business line. Now, this system helps ensure that business units are charged fairly for the liquidity they consume, encouraging behavior that aligns with the bank's overall liquidity strategy. For example, a business that relies on short-term funding to finance illiquid assets would face a higher internal funding charge, discouraging risky mismatches. Banks also invest in regulatory reporting platforms. These are essential for meeting external requirements such as submitting the LCR and NSFR returns to supervisors. In the UK and EU, these reports must be submitted regularly and often under tight timelines. The accuracy, completeness, and timeliness of these returns are critical. Errors can lead to supervisory scrutiny, penalties, or even reputational damage. In today's environment, system integration is a major challenge. Liquidity management requires data from a wide range of systems, core banking platforms, trading systems, payment infrastructure, risk models, and finance systems. Harmonizing this data across products, currencies, legal entities, and geographies is a major operational effort. That's why banks increasingly invest in data governance frameworks, appointing data owners, establishing quality controls, and using reconciliation tools to ensure reliability. For international banks, coordination across legal entities and jurisdictions adds another layer of complexity. Liquidity can be trapped in subsidiaries due to local regulations, ring fencing, or currency controls. A group-level liquidity surplus may hide shortfalls in specific regions. To manage this, banks often establish entity-level liquidity risk frameworks, ensuring that each legal entity is self-sufficient under stress. Group Treasury monitors the overall picture and allocates resources as needed, but also works closely with local Treasury teams to understand local nuances. Regulators increasingly expect banks to manage liquidity on both a solo and consolidated basis. Now, that means demonstrating that each entity can survive its own stress scenario, not just relying on the strength of the parent. In the UK, the PRA is explicit about this expectation. In the EU, the ECB supervisory approach is similar. Cross-border liquidity transfers may require approvals or face restrictions in a crisis. Banks must prepare accordingly, often by maintaining buffers locally and establishing intragroup funding arrangements that can be executed quickly and legally under stress. Communication also plays a vital role. Liquidity managers must maintain regular dialogue with central banks, clearinghouses, payment system operators, and key counterparties. During stress events, open lines of communication can be the difference between resolution and escalation. Many banks conduct liquidity dry runs, tabletop exercises that simulate a crisis and test the bank's ability to execute its contingency plans, escalate internally, and engage with external stakeholders. And culture matters too. A strong liquidity culture is one where business decisions are made with awareness of their funding implications, where Treasury and risk are seen as partners rather than enforcers, and where liquidity is considered not just in crisis, but as part of day-to-day management. Now, this culture is supported by training, communication, and the tone from the top. When boards and senior executives talk about liquidity risk, not just as a compliance issue, but as a strategic priority, it cascades through the organization. Let's not overlook outsourcing and third-party risk, which increasingly plays a role in liquidity. Banks often rely on external service providers for data feeds, analytics tools, cloud hosting, or even some treasury functions. These dependencies create new risks. If a key vendor fails or is disrupted, the bank's ability to monitor or manage liquidity may be impaired. Regulators expect banks to map these dependencies and ensure robust controls are in place. Now, this is especially important in light of growing cyber risk and operational resilience expectations. Now, to sum up, effective liquidity management is not just about having enough cash. It's about having the right people, the right processes, the right systems, and governance in place. Treasury runs the engine room. Risk sets the guardrails. Finance provides the data. Technology powers the tools, and governance ties it all together, ensuring that decisions are informed, responsibilities are clear, and the bank can act quickly when conditions change. The structure may vary by institution, but the principles are consistent. Clear ownership, effective oversight, robust data, integrated systems, and a strong risk culture. When all of these elements are in place, a bank can manage its liquidity not just reactively, but strategically, seizing opportunities, navigating shocks, and building trust with stakeholders. In our next session, we'll shift our focus from the organizational setup to the regulatory framework, starting with the liquidity coverage ratio. We'll explore how this key metric is calculated, what it measures, and how banks manage their buffers to meet it day after day. We'll also cover the regulatory expectations around LCR reporting and how supervisors use it to assess resilience. I'll see you in the next session. Having now explored how banks organize themselves to manage liquidity risk, it's time to turn our attention to one of the most important regulatory metrics in modern liquidity management, the liquidity coverage ratio, or LCR for short. In this session, we'll deep dive into what the LCR is, why it's been created, how it's calculated, and how banks operate to meet and optimize this critical requirement. We'll look at the composition of high-quality liquid assets, how outflows and inflows are measured, and how assumptions work under stress. We'll also examine supervisory expectations in the UK and EU and discuss some of the challenges and strategies that banks use to manage LCR effectively. By the end of this session, you'll have a detailed understanding of how the LCR serves as a frontline defense in banking resilience and what it takes for a firm to manage this metric responsibly and strategically. Now, the liquidity coverage ratio was introduced as part of the Basel III reforms, which were developed in response to the global financial crisis of 2007-2008. One of the biggest lessons learned from that crisis was that banks didn't hold sufficient liquid assets to survive a short-term funding shock. Banks assumed they could roll over short-term debt, tap wholesale markets, or sell assets easily. But when panic hit, those assumptions collapsed. Confidence evaporated. Funding dried up. And the assets banks relied on for liquidity proved to be far less liquid than expected. Now, the LCR was designed to address exactly this kind of situation. Its purpose is to ensure that banks hold enough high-quality liquid assets, referred to as HQLA, to survive a 30-day period of severe but plausible stress. The idea is simple. If a bank experiences a sudden loss of funding or a sharp rise in cash outflows, it must be able to meet those needs using a reliable stock of assets that can be monetized quickly without relying on central bank intervention or assuming favorable market conditions. Now, the LCR is expressed as a ratio, and it looks like this. The stock of high-quality liquid assets divided by total net cash outflows over the next 30 calendar days must be equal to or greater than 100%. In other words, the bank must be able to meet its projected outflows in full using its own liquidity buffer for at least 1 month under stress. This gives regulators and markets confidence that the bank can handle immediate liquidity shocks. Now, let's break this down into 2 key components of the ratio. First, we have the numerator, the stock of high-quality liquid assets. HQLA are assets that can be easily and immediately converted into cash with little or no loss of value. They must be unencumbered, meaning they are not pledged as collateral elsewhere and are readily available for use in a crisis. Regulators divide HQLA into different levels based on their liquidity characteristics. Level 1 assets are the most liquid and carry no haircut in the LCR calculation. So these include cash, central bank reserves, and certain sovereign debt securities such as UK gilts, German bunds, and US treasuries. Now, these assets are considered universally liquid, even in severe stress, and form the core of most banks' buffers. Level 2 assets are split into two subcategories, Level 2A and Level 2B. Level 2A assets include certain government-guaranteed securities and highly rated covered bonds. They receive a haircut in the LCR calculation, typically 15%, and are subject to composition limits, meaning they cannot make up more than 40% of the total HQLA stock. Level 2B assets are even less liquid and include things like lower-rated corporate bonds and certain equities from major indices. Now, these receive higher haircuts, up to 50%, and are capped at 15% of the total buffer. Now, banks must constantly ensure that their HQLA portfolio meets these criteria. Assets must be legally and operationally available, and banks must demonstrate that they can convert them into cash at short notice. Some regulators conduct liquidity exercises or simulations to test whether assets classified as HQLA would actually be usable in practice. For example, the Bank of England may ask firms to demonstrate how they would monetize specific assets in a crisis scenario, including through repo operations or outright sales. Now let's look at the denominator. Total net cash outflows over the next 30 days. This is where the stress scenario comes into play. Regulators define a set of standardized assumptions about how different types of funding behave under stress. These assumptions are deliberately conservative. They're not forecasts, they're meant to model a severe situation in which clients withdraw funds, markets tighten, and credit lines are drawn down. Now, the bank must estimate its expected cash outflows and inflows over the next 30 calendar days. So outflows include retail and corporate deposit withdrawals, maturing wholesale funding, derivative collateral requirements, and committed credit facilities. Inflows include scheduled loan repayments, contractual cash receipts, and maturing investments. However, to prevent banks from relying too heavily on outflows, regulators cap the recognition of inflows at 75% of total outflows. So this ensures that banks always hold a buffer rather than depending on uncertain cash receipts. Now let's look more closely at some of the outflow assumptions. For retail deposits, regulators distinguish between insured and uninsured deposits, and between stable and less stable accounts. For example, insured deposits from a retail customer with a long-term relationship may be assigned an outflow rate of 3 or 5%, but large uninsured corporate deposits may be assigned outflow rates of 20% or higher. Operational deposits, so those held for transactional purposes, receive more favourable treatment than non-operational deposits, which may be more flighty. Wholesale funding is generally assumed to roll off in full unless the bank can demonstrate that it has legally binding commitments for renewal. Undrawn committed credit facilities to corporates are assumed to be drawn down in part or in full, depending on the counterparty type. Derivative exposures are assumed to generate margin calls under stress. These assumptions reflect the kinds of behaviours that were observed during past crises. Clients draw down lines, counterparties ask for collateral, and maturing funding becomes harder to replace. Once all expected outflows and inflows are calculated and the appropriate haircuts and caps are applied, the result is the total net cash outflow number. This is then compared to the HQLA stock. If the HQLA stock is large enough to cover these net outflows, the bank's LCR is above 100%. If not, the bank is technically non-compliant and must take action to restore its position, either by raising more liquid assets or reducing outflows. Now, in normal times, banks are expected to maintain LCR above 100% at all times. But regulators recognize that buffers are there to be used. In a real crisis, supervisors may allow temporary breaches of the LCR, providing the bank has a credible plan to restore compliance. That's why the LCR is often supplemented by internal targets. So banks may aim for 110 or 120% under normal conditions, giving themselves headroom in case of shocks. Now, managing LCR day to day is a highly operational task. Treasury teams must monitor inflows and outflows constantly, adjust funding strategies, and rebalance the HQLA portfolio to meet regulatory and internal targets. You then have risk teams reviewing the underlying assumptions, conducting sensitivity analysis, and monitoring early warning indicators that might suggest increased outflows. For example, a drop in market confidence, increased media attention, or unusual client behavior could all point to rising liquidity pressure. One of the key challenges in managing LCR is the balance between liquidity and profitability. Holding large amounts of high-quality liquid assets often comes at a cost. Now, these assets tend to yield less than loans or investments in higher risk instruments. So there is often a natural tension between maximizing returns and meeting LCR requirements. And this is where strategic decisions come into play. Banks must decide how much buffer to hold centrally versus in legal entities, which assets to include in the buffer, and how to fund them. Another challenge is the volatility of the ratio itself. Because outflows and inflows are recalculated daily, the LCR can change rapidly, especially in times of stress. A single corporate client moving a large deposit or a swing in derivative collateral can materially alter the bank's LCR. So this requires systems that can track changes in near real time and governance processes that allow for swift action when needed. From a regulatory perspective, LCR is a key supervisory tool. Authorities like the PRA and the ECB monitor LCR closely using daily or monthly returns submitted by banks. Now, these returns include detailed breakdowns of HQLA composition, outflow and inflow categories, and assumptions used. Supervisors use this data to assess the bank's resilience, identify trends, and spot emerging risks. They may challenge banks on the usability of their HQLA or ask for more conservative assumptions if market conditions deteriorate. In the UK, the PRA follows the guidelines set by the European Banking Authority, which apply across the EU and have been largely retained post-Brexit. Firms must report LCR at group level and for certain material subsidiaries. They must also produce liquidity metrics as part of their ILAAP submission, which is reviewed annually as part of the Supervisory Review and Evaluation Process, or SREP for short. If a bank's LCR is deemed insufficient, supervisors may impose Pillar 2 liquidity add-ons or require remediation actions. Stress testing plays an important role here. Banks are expected to test the robustness of their LCR under different scenarios, not just the regulatory baseline. They may run internal scenarios involving idiosyncratic shocks, market-wide disruptions, or combinations of both. Now, these tests help identify weaknesses in the liquidity buffer or gaps in funding strategy. For example, a scenario might assume a loss of unsecured funding, a credit rating downgrade, and higher client withdrawals. The LCR is then recalculated to see how the buffer holds up. Beyond stress testing, firms also produce liquidity contingency plans. These plans outline how the bank would respond if the LCR fell below 100%. What assets would be monetized first? How would communications be managed with regulators, clients, and investors? Who would make key decisions? How would funding be replaced? These questions must be answered clearly with defined triggers, governance, and playbooks. Regulators review these plans and often simulate liquidity events to test them. A special consideration arises in cross-border banking groups. The LCR must be met not only at consolidated level, but also at material subsidiary level. Now, this can be challenging where liquidity is fragmented across jurisdictions and where ring-fencing rules limit intra-group transfers. Banks must plan their HQLA allocation accordingly, ensuring each legal entity can meet its own LCR, even if group-level liquidity is strong. Some banks use internal LCR metrics alongside the regulatory version. For example, they may apply more conservative outflow assumptions or include additional stress factors not required by regulation. Now, these internal metrics help management stay ahead of potential issues and maintain a strong liquidity culture. They also support strategic decision making, such as launching new products, entering new markets, or managing balance sheet growth. To summarize, the liquidity coverage ratio is one of the cornerstones of modern liquidity regulation. It forces banks to hold a robust, reliable buffer of high-quality assets and to understand their cash flow dynamics under stress. It provides supervisors with a daily snapshot of resilience and ensures that short-term shocks do not turn into full-blown crises. But meeting the LCR is not just a compliance exercise. It requires active management, clear governance, and strategic thinking. The ratio must be embedded into business planning, product design, and risk management processes. In our next session, we'll turn to the other major liquidity metric, the net stable funding ratio. Now, while the LCR focuses on the next 30 days, the NSFR takes a longer-term view, ensuring that banks fund their assets with stable sources over a one-year horizon. Together, these two metrics form the backbone of global liquidity standards. In our next session, we'll explore how the NSFR works, what it measures, and how banks structure their balance sheets to comply with it without sacrificing profitability. I'll see you in the next session. So far, we've focused heavily on how banks prepare to survive short-term stress, particularly through the liquidity coverage ratio. But liquidity risk isn't just about what happens over the next 30 days. It's also about the long-term structure of the balance sheet. In other words, how stable a bank's funding is in relation to the assets it holds. In this session, we're going to explore the second major pillar of global liquidity regulation, the net stable funding ratio, or NSFR for short. We'll break down how it works, what it measures, how it's calculated, and how banks adapt their funding models to meet it. We'll also explore its interaction with business models, profitability, and risk appetite. By the end of this session, you'll have a detailed understanding of how the NSFR complements short-term measures and helps to protect banks from structural liquidity risks over a longer horizon. The NSFR was introduced as part of the Basel III reforms, just like the LCR, but it serves a different purpose. While the LCR focuses on a bank's ability to withstand a 30-day stress event, the NSFR looks at a one-year time frame. Its goal is to reduce funding risk by ensuring that banks do not rely excessively on short-term, unstable funding to finance long-term or illiquid assets. It's about maturity transformation, not just in theory, but in measurable practice. Now, at its core, the NSFR is a simple ratio. The amount of available stable funding divided by the amount of required stable funding, and it must be at least 100%. In other words, a bank must fund its longer-term activities with a sufficiently stable pool of liabilities. Now, the more stable the funding source, the more credit a bank gets for it. The more illiquid or long-term the asset, the more stable funding it needs to support it. Now, this pushes banks towards safer, more balanced balance sheets. So let's start with the numerator, available stable funding, or ASF for short. ASF reflects the portion of a bank's funding base that is expected to remain in place for at least 1 year, even under conditions of stress. Different sources of funding are assigned ASF factors, which represent their perceived stability. Now, these factors are regulatory estimates based on empirical evidence from past crises and behavioural assumptions. So retail deposits receive the highest ASF factors, typically 90 to 95%, because they tend to be sticky and resilient. Even under stress, most retail customers do not withdraw their deposits entirely or even at all, particularly if those deposits are insured. Corporate deposits from small and medium-sized enterprises are also treated favourably, though with slightly lower ASF factors. Large corporate and financial institution deposits, especially if they are short-term or operational in nature, receive lower ASF factors, often 50% or less. Longer-term debt instruments, such as bonds or term deposits with maturities over 1 year, are treated as fully stable and receive a 100% ASF factor. Equity, including common shares and retained earnings, is also considered stable funding. On the other end of the spectrum, short-term wholesale funding, particularly that maturing in less than 6 months, is considered highly unstable and receives little or no ASF credit. Derivative liabilities are also treated conservatively, often receiving zero ASF credit as well. Now let's turn to the denominator, required stable funding, or RSF for short. This is where the asset side of the balance sheet comes into play. Each asset is assigned an RSF factor, which reflects how illiquid or long-dated it is. The idea is that the more difficult it is to monetize an asset in a crisis, or the longer it takes to repay, the more stable funding the bank should have in place to support it. For example, cash and central bank reserves receive a 0% RSF factor. They are already liquid and don't require stable funding. Similarly, assets expected to be repaid within 1 year, such as short-term loans or interbank placements, receive low RSF factors, typically 10 to 50%. But longer-dated loans, mortgage portfolios, and other illiquid assets receive RSF factors of 65 to 85% or even higher. Now, these are the assets that tie up funding for longer periods and pose greater refinancing risks. Assets that are encumbered, meaning pledged as collateral, receive higher RSF factors because they are less accessible. Now, off-balance sheet exposures also contribute to RSF. For example, undrawn credit facilities and guarantees require stable funding because they can be drawn down under stress. Derivative assets, just like derivative liabilities, are treated cautiously, particularly where they involve collateral or long settlement times. Even certain securities held for trading or liquidity purposes may require stable funding, depending on their characteristics. Now, once the ASF and RSF components are calculated and weighted, the bank divides ASF by the RSF to arrive at its NSFR. A ratio of 100% or higher means the bank has sufficient stable funding to support its long-term and illiquid assets. A ratio below 100% indicates a structural funding mismatch, where the bank is too reliant on short-term or unstable liabilities to fund assets that take time to mature or sell. Now, one of the biggest differences between LCR and the NSFR is timing. The LCR is about short-term survival. The NSFR is about long-term sustainability. A bank could have a strong LCR, lots of liquid assets and low short-term outflows, but still have a poor NSFR if its funding base is too short-term relative to its asset book. This distinction is important. It means that liquidity management isn't just about daily operations. It's also about strategic funding decisions, product design, and business model planning. From a management perspective, the NSFR influences how banks think about funding strategy. For example, it encourages banks to issue longer-term debt, such as 3 or 5 year bonds, rather than relying heavily on overnight or one-week repo. It also incentivizes banks to maintain strong retail deposit franchises, which provide stable, low-cost funding. At the same time, it discourages excessive growth in long-term illiquid assets unless those assets are matched with appropriately stable liabilities. The NSFR also affects product pricing and design. For example, a business unit that wants to grow its long-term mortgage portfolio may be asked to contribute more to funding costs or to limit growth unless stable funding can be sourced. Funds transfer pricing systems reflect this by allocating internal funding charges based on asset RSF profiles and funding ASF contributions. Now, this creates a feedback loop between risk, finance, and commercial strategy, ensuring that liquidity considerations are baked into business decisions. Now, from a regulatory standpoint, the NSFR is now part of the global minimum standards under Basel III, and it has been implemented across major jurisdictions, including the UK and EU. Now, in the UK, the PRA requires banks to report their NSFR regularly, both at consolidated group level and at material legal entity level. Supervisors assess NSFR as part of the wider SREP process, alongside the LCR, ILAAP, and other risk indicators. Regulators may also set Pillar 2 requirements or expectations where NSFR falls short or where a bank's business model creates concerns about structural liquidity risk. For example, a bank that relies heavily on volatile wholesale funding or that has large concentrations of illiquid assets may face increased scrutiny or additional reporting obligations. Supervisors may ask for remediation plans, targeted stress testing, or additional disclosures to investors and the market. Now, banks respond to this in several ways. First, they maintain internal NSFR targets, often set above the regulatory minimum. Now, these targets provide a buffer against volatility in funding markets, shifts in asset composition, or changes in regulatory interpretation. Second, they regularly rebalance their asset and liability mix to optimize NSFR. Now, this might involve issuing term debt, attracting more retail deposits, or adjusting the maturity structure of the investment portfolio. Now, Treasury teams play a central role here, managing the funding mix, planning debt issuance, and engaging with investors and rating agencies. Risk teams model NSFR under different scenarios, such as interest rate shocks, asset growth, or funding disruptions, to understand how sensitive the ratio is and where vulnerabilities lie. Finance teams align NSFR with balance sheet strategy and profitability targets. The goal is not just compliance, but resilience and adaptability. Now, it's worth noting that the NSFR is not a daily operational tool like the LCR. It's more of a strategic ratio, calculated on a monthly or quarterly basis and used to inform long-term planning. But that doesn't make it less important. In fact, some of the biggest liquidity crises in history have resulted from structural mismatches that the NSFR is designed to address. The collapse of Silicon Valley Bank, for example, highlighted what happens when a bank finances long-term assets with short-term, non-sticky deposits, particularly in a rising interest rate environment. Now, let's talk briefly about some of the practical challenges in managing the NSFR. Now, one is data granularity. Because the NSFR relies on maturity profiles and behavioral assumptions, banks must have detailed, accurate data on their assets and liabilities across currencies, legal entities, and business lines. Another challenge is forecasting. Since the NSFR looks ahead 1 year, assumptions about rollover behavior, prepayments, and customer drawdowns become critical. Now, if these assumptions are wrong, the bank may find itself with an unexpected shortfall. Now, there's also a challenge of incentives. Business lines may not always see the full cost of stable funding, especially if internal pricing isn't aligned. Treasury and risk must work together to ensure that pricing reflects true liquidity cost and that businesses are incentivized to fund themselves sustainably. Otherwise, the bank risks creeping back toward the same maturity mismatches that have triggered past crises. And finally, there's the global dimension. NSFR must be met not only at group level, but also in material subsidiaries. And regulators may impose local requirements and add-ons. Now, this creates complexity for banks operating in multiple jurisdictions, especially where liquidity is fragmented by legal, regulatory, or currency barriers. Now, Group Treasury must coordinate with local entities, balance efficiency with compliance, and ensure that funding strategies support both local and consolidated NSFR requirements. To wrap up this session, the net stable funding ratio is a vital part of modern liquidity management. It shifts the focus from short-term shocks to long-term sustainability, forcing banks to think carefully about how they fund themselves and how they grow. It discourages excessive reliance on volatile funding sources, and it promotes a healthier, more balanced banking system. Now, while the LCR tells us whether a bank can survive the next 30 days, the NSFR tells us whether it can do so again next year and the year after that. Now, in our next session, we'll step back from the quantitative metrics and explore the qualitative side of regulation, the Internal Liquidity Adequacy Assessment Process, or ILAAP for short. Now, this framework requires banks to demonstrate not just what their numbers say, but how they understand, govern, and plan for liquidity risk. It's about narrative, oversight, and credibility. In session 7, we'll look at what a good ILAAP looks like, what regulators expect, and how firms use it to build trust and resilience. I'll see you in the next session. Now, up until this point in the course, We've focused on the quantitative side of liquidity risk, the hard metrics, the buffers, and the ratios that banks use to measure and manage their liquidity position. But numbers alone don't tell the full story. Supervisors also want to understand how a bank thinks about liquidity, how it governs it, how well it anticipates risks, and how prepared it is to respond when the unexpected happens. That's where the internal liquidity adequacy assessment process comes into play. In this session, we'll explore what the ILAAP is, how it works, what regulators in the UK and EU expect from it, and how banks can use it not just to comply with regulation, but to build a robust, credible, and forward-looking liquidity management framework. By the end of this session, you'll understand how ILAAP connects the dots between data, governance, risk appetite, and supervisory dialogue. Now, the ILAAP is part of the wider Pillar 2 framework under the Basel Accord. Now, while Pillar 1 sets out minimum quantitative requirements like the LCR and NSFR, Pillar 2 focuses on the internal processes banks use to assess and manage risks that aren't fully captured in the standard rules. So ILAAP sits alongside its better-known sibling, ICAP, the Internal Capital Adequacy Assessment process. Now, where ICAP is about capital adequacy, ILAAP is about liquidity adequacy. So at its core, the ILAAP is a document and a process that explains how a bank ensures it has enough liquidity in all relevant currencies and entities to meet its obligations as they fall due, even under stress. Now, it's submitted annually to the regulator and reviewed as part of the SREP, the Supervisory Review and Evaluation process. But the ILAAP is not just a report. It's a reflection of the bank's entire approach to liquidity risk. It includes governance, strategy, risk appetite, stress testing, contingency planning, and so much more. It must be tailored, credible, and aligned with the bank's actual practices, not a generic or box-ticking exercise. Now, in the UK, the ILAAP is reviewed by the PRA, which has published detailed supervisory statements outlining its expectations. In the EU, the European Central Bank and national competent authorities follow similar guidelines issued by the EBA, the European Banking Authority. Now, while there are some regional differences, the core principles are broadly aligned. So let's begin by looking at what a strong ILAAP needs to cover. First and foremost, it must include a clear statement of the bank's liquidity risk appetite. Now, this means articulating how much liquidity risk the firm is willing to take, under what conditions, and how that appetite is translated into limits, metrics, and decision making. The risk appetite should be approved by the board, reviewed regularly, and expressed in both quantitative and qualitative terms. It should cover things like minimum buffer sizes, acceptable reliance on different funding sources, and target levels for metrics such as LCR and NSFR. The next key component is governance. The ILAAP must explain how liquidity risk is managed across the three lines of defence. Who is responsible for what, how decisions are made, and how issues are escalated. It should describe the role of the board, executive committees like ALCO, and specialist teams such as Treasury, Risk, and Finance. It should also show how liquidity is integrated into business planning, new product approval, and strategic decisions. Now, regulators want to see that liquidity risk is not siloed, but embedded throughout the organisation. Another critical section is the liquidity risk identification process. Now, this involves describing how the bank identifies the sources of liquidity risk it faces, whether that's funding concentration, market illiquidity, contingent liabilities, intraday risk, or cross-currency exposures. The bank must explain the methodologies it uses to assess these risks, the systems and data sources involved, and how this analysis feeds into risk management. The goal is to show that the firm understands its own liquidity profile, not just through regulatory metrics, but in real operational terms. The ILAAP must also include detailed liquidity stress testing. Now, this is one of the most scrutinised parts of the document. Banks must describe the scenarios they use, the assumptions they make, the results they observe, and the actions they would take in response. Stress tests should include both idiosyncratic and market-wide events, as well as combined scenarios. They should cover multiple time horizons, currencies, and entities. Assumptions must be clearly documented, justified, and aligned with experience from past crises. Importantly, regulators want to see that stress test results feed into decision making. For example, if a scenario reveals that the bank would face a shortfall in day 10 of a market-wide stress, the ILAAP should explain how the firm would address that. Would it increase its buffer, adjust its funding strategy, revisit its product pricing? The goal is not just to run the test, but to act on it. Another major component is the Liquidity Contingency Funding Plan, or CFP for short. Now, the CFP outlines how the bank would respond to a liquidity stress event in practice. It includes the governance process for invoking the plan, the triggers that would prompt action, the tools available to respond, and the communication strategies for internal and external stakeholders. It must be detailed, realistic, and tested. Now, regulators increasingly expect firms to conduct dry runs or simulations of their CFP to demonstrate operational readiness. Now, the ILAAP also needs to explain how the bank manages liquidity under normal conditions. Now, this includes describing how liquidity metrics are monitored day to day, how limits are set and reviewed, and how Treasury and risk teams interact. The document should show how the firm complies with the LCR and NSFR, how it manages intraday liquidity, and how it allocates liquidity costs internally through funds transfer pricing. The PRA places strong emphasis on the alignment between ILAAP content and actual practice, meaning the way liquidity is managed must match what the ILAAP describes. For international banks, the ILAAP must address group versus entity level liquidity. The PRA expects firms to demonstrate that material subsidiaries can stand alone in stress, without assuming group support. This means having entity-specific liquidity buffers, governance, and contingency plans. The ILAAP should also explain how intragroup funding works, what legal agreements are in place, and how these would hold up under stress. Regulators want to avoid a situation where liquidity appears strong at group level, but is fragmented or trapped in practice. Currency risk is another area of focus. The ILAAP should show how the bank manages liquidity across currencies, particularly for significant foreign currency exposures. So this includes describing FX swap strategies, currency-specific buffers, and the impact of currency movements on funding and liquidity risk. The PRA has issued specific guidance on foreign currency liquidity, requiring firms to monitor and manage currency mismatches with the same rigor as domestic liquidity. Now, an often overlooked part of the ILAAP is the link between liquidity and strategy. Regulators expect firms to explain how liquidity considerations influence business planning, product design, and growth strategies. For example, if a bank plans to expand its long-term mortgage lending, the ILAAP should explain how that growth will be funded in a stable way. If a new product requires committed lines or collateral, the liquidity implications must be assessed. Now, the document should demonstrate that liquidity risk is factored into decisions, not just measured after the fact. Now, from a supervisory perspective, the ILAAP is one of the key inputs into the supervisory review and evaluation process. Regulators review the ILAAP alongside ICAP, recovery plans, and other submissions. They assess the quality of governance, the credibility of assumptions, and the alignment between stated policies and actual practices. They also compare firms across the industry, identifying outliers or emerging risks. If a regulator identifies weaknesses in a firm's ILAAP, such as overly optimistic stress scenarios, insufficient contingency plans, or gaps in governance, they may impose Pillar 2 liquidity requirements. Now, these are additional buffer expectations that go beyond the minimum LCR and NSFR. The firm may also be asked to enhance its reporting, improve systems, or conduct remedial action. In severe cases, liquidity add-ons may become binding constraints, limiting the firm's ability to grow or distribute capital. Now, one of the most important features of a strong ILAAP is consistency. The assumptions used in stress testing must match those used in planning. The governance described in the document must match how decisions are actually made. The risk appetite must be reflected in metrics and limits. If a firm's ILAAP describes a conservative approach, but its balance sheet tells a different story, regulators will notice. That's why alignment is so important, not just to pass supervisory review, but to manage liquidity risk effectively. In recent years, supervisors have also begun using thematic reviews to assess ILAAPs across the industry. For example, the PRA may focus on how banks manage intraday liquidity or test the usability of HQLA. Now, the results of these reviews are shared with the industry, providing benchmarks and expectations. Now, this raises the bar for all firms and encourages continuous improvement. The message is clear. ILAAP is not static. It must evolve with the bank, the market, and regulatory expectations. Now, let's briefly talk about presentation and ownership. A good ILAAP is not just a risk team document. It should be co-owned by Treasury, Finance, Risk, and the business. It should reflect input from across the bank. It should be approved by the board, discussed at ALCO, and known to key decision makers. The best ILAAPs are readable, coherent, and structured in a way that makes them useful, not just to regulators, but to the firm itself. Many banks are moving away from long, boilerplate documents towards more focused, strategic reports. They use dashboards, scenario matrices, and decision trees to show how they manage risk. They integrate the ILAAP with internal management information, stress testing outputs, and business plans. They use the ILAAP as a living document, updated as conditions change, rather than a once-a-year compliance burden. To summarize, the ILAAP is the qualitative heart of liquidity risk management. It connects metrics with governance, data with judgment, and regulation with strategy. It tells the story of how a bank understands and manages its liquidity, and how it plans to respond when that understanding is tested. A strong ILAAP builds trust with supervisors, confidence with stakeholders, and resilience within the firm. It's not just about meeting rules, it's about being prepared. In our next session, we'll explore one of the most critical tools for embedding liquidity discipline across the bank: funds transfer pricing, or FTP for short. We'll look at how FTP works, how it helps allocate liquidity costs, and how it shapes decision-making in every part of the bank, from lending desks to trading books. In session 8, we'll see how liquidity becomes part of the economic DNA of a bank, not just a risk to be monitored, but a cost to be managed and optimized. I'll see you in the next session. At this point in the course, we've explored the regulatory metrics, the organizational structures, and the strategic frameworks that underpin liquidity risk management in banking. But one question remains. How do banks make sure that liquidity is considered not just by Treasury or risk, but by every part of the organization? From lending desks to investment arms, from product developers to relationship managers. How do they ensure that the cost and value of liquidity is reflected in day-to-day decisions, in pricing, and in performance evaluation? That's where funds transfer pricing, commonly known as FTP, comes in. In this session, we're going to examine how FTP works, why it matters, how it's designed, and what challenges it brings. By the end, you'll understand how FTP acts as the internal market for liquidity within a bank, and how it transforms liquidity from a central function into an enterprise-wide discipline. Now, funds transfer pricing is an internal mechanism that allows banks to allocate the costs and benefits of funding and liquidity to the businesses that use them. Now, it acts as a bridge between Treasury, which manages the bank's funding and liquidity centrally, and the various business lines that generate and consume funds. Now, without FTP, there's no way to measure the true profitability of a loan, deposit, or trading strategy, because you're missing the cost of liquidity. Now, the basic principle is this. When a business unit uses funding, for example, by issuing a loan, it should be charged an internal rate that reflects the cost of raising those funds for the bank. Now, conversely, when a unit generates funding, say by attracting deposits, it should be credited for the value of those funds. Now, the result is an internal price for liquidity that flows through the bank's management accounts, allowing for more accurate pricing, performance measurement, and risk-adjusted decision making. So let's look at how this works in practice. Suppose a lending desk wants to issue a 5-year corporate loan. Treasury will have to fund that loan, either by using existing liquidity, issuing new debt, or managing the asset within the overall liquidity buffer. Now, through the FTP system, Treasury will charge the lending desk a 5-year internal funding rate. Now, this rate might be based on the bank's own cost of funds, adjusted for market conditions, liquidity premiums, and regulatory costs like the NSFR. Now, the lending desk then uses this internal rate as part of its pricing model, ensuring that the interest rate charged on the loan covers not only credit risk and operational costs, but also liquidity cost. Now consider a deposit-taking desk. When it attracts stable retail deposits, it provides a funding benefit to the bank. Now, those deposits can be used to fund assets or reduce wholesale borrowing. Now, the FTP system rewards the deposit desk with an internal credit, reflecting the value of those funds. Again, this credit might be based on the market value of comparable funding, adjusted for stability, term, and liquidity profile. Now, this creates incentives for deposit desks to attract stable, low-cost funding, and for lending desks to use liquidity wisely. Now, FTP can be applied in different ways depending on the bank's structure and objectives. In its simplest form, FTP uses a central pool model where Treasury acts as the internal bank. Now, all business units transact with Treasury rather than each other. Treasury then sets the transfer prices based on market rates, funding strategy, and regulatory requirements. Now, this approach allows for centralized control and consistency across the organization. Now, a more complex approach is dual FTP, where both interest rate risk and liquidity risk are priced separately. Now, in this model, one component reflects the term structure of interest rates, often using a risk-free curve like SONIA or Euribor, and the other reflects the liquidity premium required to fund different types of assets. Now, this helps separate the pure funding cost from the liquidity value, giving more granular insights into business performance. Now, some banks go even further, introducing behavioral FTP. Now, this means adjusting the transfer prices based on expected, not contractual maturities. For example, a retail current account may be contractually callable on demand, but in practice, customers leave their balances untouched for years. Now, the FTP system can model these behaviors and assign longer effective maturities, resulting in higher internal credit for the deposit desk. Now, the same applies to prepayable loans, where behavioral models adjust the funding charge based on the expected life. Now, one of the key benefits of FTP is that it embeds liquidity considerations into product pricing. When a lending desk sees a higher FTP charge for a long-term illiquid loan, it may adjust its pricing, reduce its term exposure, or explore alternative structures. When a deposit desk receives more credit for stable funding, it may invest more in customer retention and relationship building. Now, these behaviors improve the bank's overall funding profile and reduce reliance on volatile sources. Now, FTP also enhances performance management. By assigning funding costs and credits at the business unit level, FTP allows management to assess profitability on a more realistic basis. A product that looks profitable on a gross margin basis may turn out to be value destructive once liquidity costs are factored in. And conversely, a deposit product with low interest revenue may be highly valuable because it provides stable, cheap funding. The FTP helps surface these dynamics, enabling better decision-making and resource allocation. Now, in the context of regulation, FTP supports compliance with liquidity rules like the LCR and NSFR. Now, by making business units aware of the funding implications of their actions, FTP helps align day-to-day activities with regulatory requirements. For example, if the NSFR penalizes short-term funding, Treasury can reflect that cost in the FTP curve, discouraging business units from creating maturity mismatches. FTP also supports ILAAP by showing how the bank manages liquidity internally and how costs are distributed. Now, designing an effective FTP system is not without its challenges. One of the biggest is transparency. Now, business units often question how the transfer prices are calculated, particularly when they change. Now, to be credible, the FTP methodology must be well documented, explainable, and aligned with market reality. Treasury must engage with the businesses, provide clear rationale for pricing decisions, and be open to feedback. Another challenge is consistency. The FTP system must be applied uniformly across products, business lines, and geographies. Inconsistent application can lead to gaming, arbitrage, or misaligned behaviours. It can also distort performance reporting and reduce the value of FTP as a management tool. Now, a further challenge lies in accuracy. FTP relies on inputs from multiple systems, market rates, behavioural models, balance sheet data, and regulatory calculations. Errors or delays in these inputs can create noise in the transfer prices, leading to incorrect signals. That's why many banks invest in dedicated FTP infrastructure, including automated data feeds, audit trails, and analytics dashboards. Now, governance is also key. Most banks have an FTP committee or Treasury forum that oversees the design, implementation, and periodic review of the FTP framework. Now, this committee includes representatives from Treasury, Risk, Finance, and the businesses. It sets the pricing methodology, approves model changes, and ensures alignment with strategic objectives. In some banks, FTP is subject to internal audit or external review, particularly when it plays a material role in business planning or remuneration. Now, as with many aspects of liquidity management, FTP has evolved significantly over the years. Now, in the past, many banks used static or overly simplistic FTP models, often based on book rates or average costs. Today, leading institutions use dynamic FTP models that reflect current market conditions, regulatory constraints, and behavioural insights. Now, these models are updated regularly, stress-tested, and aligned with risk appetite. There's also a growing interest in using FTP to manage contingent liquidity risks. For example, a business unit that originates large undrawn credit lines may be charged an FTP add-on to reflect the potential drawdown risk under stress. Now, similarly, businesses that generate volatile funding flows may be penalised, while those that deliver consistent, sticky balances receive more favourable treatment. This extension of FTP helps align business activity with the broader liquidity risk framework. Now, the use of FTP also intersects with climate risk and ESG considerations. Some banks are exploring green FTP curves, where funding costs are adjusted to reflect the sustainability profile of a product. For example, green loans or climate-friendly investments may receive more favourable FTP rates, encouraging the business to support ESG objectives. Now, while still emerging, this is part of a broader trend to integrate sustainability into financial risk management. Now, in the context of digital banking, FTP faces new challenges and opportunities. Customer behaviours are changing, balance volatility is increasing, and data analytics are becoming more sophisticated. FTP systems must adapt, using real-time data, advanced behavioural models, and machine learning techniques to better estimate liquidity patterns and assign transfer prices. Now, as embedded finance and digital platforms grow, FTP will need to evolve to support these new business models. To summarise, funds transfer pricing is a powerful tool for embedding liquidity risk awareness throughout a bank. It ensures that funding and liquidity are not just managed centrally, but shared, priced, and owned across the business. It creates incentives, supports strategy, enhances performance management, and helps deliver regulatory compliance. Done well, FTP transforms liquidity from a cost centre into a driver of value and resilience. In our next session, we'll look at how banks prepare for the unexpected through contingency funding plans. We'll explore what makes a good contingency plan, how banks simulate crisis scenarios, and how they ensure that liquidity actions can be taken quickly, effectively, and with confidence. I'll see you in the next session. Up until now, we've established how banks measure, monitor, and manage liquidity under normal conditions. We've looked at internal pricing through FTP, regulatory metrics like the LCR and NSFR, and the governance and planning processes that tie it all together. But what happens when normal conditions break down? What if the assumptions that underpin funding strategies no longer hold, markets freeze, and clients start pulling out liquidity en masse? Now, in this session, we're going to focus on contingency funding plans, also known as CFPs, and how banks prepare to act when things go wrong. We'll explore what a good CFP looks like, how it's structured, what regulators expect, and how banks test and operationalize these plans. By the end, you'll understand how CFPs serve as the blueprint for survival during a liquidity crisis, and how they transform planning into action. Now, a contingency funding plan is exactly what it sounds like. A predefined strategy that outlines how a bank will respond to a liquidity stress event. Now, it sets out the actions a bank will take to preserve liquidity, maintain market confidence, and restore normal operations. Now, importantly, a CFP is not just a theoretical document. It must be realistic, actionable, and understood by the teams responsible for implementing it. Now, in a crisis, there is no time to figure things out from scratch. The CFP is the playbook. Now, the primary objective of a CFP is to ensure that a bank can continue to meet its obligations as they fall due, even if funding markets are closed, counterparties are nervous, and liquidity inflows are delayed or reduced. Now, it should enable the bank to weather an idiosyncratic shock, like a credit downgrade or a rogue trading event, or a market-wide event like a systemic banking crisis or a geopolitical disruption. Now, most importantly, the plan must cover both the technical and the human aspects of crisis response. So access to liquidity and the processes to get it, as well as decision-making structures, communications, and escalation pathways. So let's break down the key components of an effective contingency funding plan. The first element is a clear set of early warning indicators. Now, these are measurable signals that suggest liquidity conditions may be deteriorating. They serve as the trigger points for escalating from normal operations to contingency mode. Examples include a rapid decline in the LCR or NSFR, large client withdrawals, widening credit spreads, an increase in repo haircuts, loss of access to specific funding sources, or a sharp rise in collateral demands. Banks typically define a set of internal thresholds for each indicator. Now, if a threshold is breached, this may trigger a predefined response, such as enhanced monitoring, liquidity committee meetings, or preparation to activate funding options. Importantly, indicators must be forward-looking, sensitive, and specific. They should be calibrated based on past stress events, tailored to the bank's business model, and monitored in near real time. Too many false alarms can erode credibility. Too few warnings can leave the bank unprepared. The second key element is governance and escalation procedures. The CFP must define who is responsible for what during a liquidity crisis. Who chairs the Crisis Liquidity Committee? Who makes the decision to activate the plan? How are decisions escalated to the board, and how are regulators informed? These are not hypothetical questions. They must be clearly answered in the plan. Now, roles and responsibilities must be assigned, documented, and understood by everyone involved. Now, many banks use a tiered escalation model, where different levels of stress lead to different levels of response. For example, Stage 1 might involve heightened monitoring and information gathering. Stage 2 might involve preparing liquidity actions and informing key stakeholders. Stage 3 might be full activation of the plan, including monetization of buffers, access to central bank facilities, or invocation of intragroup support agreements. Each stage should be tiered to specific indicators and have defined governance procedures. The third critical part of a CFP is the menu of liquidity actions. Now, this is the heart of the plan, a list of the actions the bank can take to generate liquidity in a crisis. Now, these actions are typically grouped into categories. The first category is the use of HQLA. The first line of defense is the bank's own buffer of high-quality liquid assets. Now, these can be sold or used in repo transactions to raise cash quickly. The CFP should specify which assets will be used first, where they are held, how they will be mobilised, and who has the authority to act. The second category is access to market funding. Now, the plan should list potential funding sources, such as secured or unsecured borrowing, access to commercial paper or certificates of deposit markets, and backup lines with counterparties. Now, each source should be assessed for availability under stress, legal readiness, and expected capacity. The third category is use of central bank facilities. Now, most central banks offer standing or emergency facilities that banks can use during liquidity events. Now, these often require specific operational steps such as collateral eligibility, account access, or advance approvals. The CFP must document the process for accessing these facilities, including haircuts, pricing, operational cut-off times, and key contacts. Fourth category is intergroup funding. For banking groups with multiple entities, internal liquidity support can be a key tool. The CFP should describe intragroup limits, legal agreements, tax and regulatory considerations, and operational readiness for these transfers. Customer or balance sheet actions is another category. These include measures such as slowing new lending, tightening deposit pricing, or selling non-core assets. Now, while not always first-line tools, these actions can be useful to stabilise the balance sheet or send positive signals to the market. Now, each action must be described in operational detail. Who executes it? How long does it take? What are the risks? What systems are needed? What approvals are required? Regulators expect banks to go beyond generalities. The plan must show that the bank has done the preparation and can act under pressure. Now, next comes the communication strategy. In a liquidity crisis, perception is often as important as reality. A poorly handled announcement, a delayed update, or mixed messages can worsen the situation. The CFP should include a communications plan for internal and external stakeholders, employees, customers, counterparties, regulators, investors, and the media. It should identify spokespersons, draft holding statements, and define escalation channels. Now, the regulatory engagement plan is especially important. Regulators must be informed promptly of any material liquidity concerns, especially if the LCR or NSFR falls below 100%. The CFP should outline when and how regulators will be contacted, what information will be shared, and how follow-up will be handled. Now, for this, transparency and credibility are key. Firms that engage openly and early tend to receive more supportive responses. Now, another essential feature of a good CFP is testing. A plan that looks good on paper may fail in practice if it's not regularly tested. Banks conduct liquidity simulation exercises or dry runs where teams act out a crisis scenario, simulate discussions, and identify gaps. Now, these exercises test not just technical readiness, but also human dynamics, decision speed, clarity of roles, effectiveness of communication, and escalation flow. Now, test outcomes should be documented with lessons learned fed back into the plan. Now, testing is especially important in complex banking groups where liquidity may be dispersed across legal entities, jurisdictions, or currencies. A dry run can reveal operational delays, legal uncertainties, or coordination issues that would be fatal in a real crisis. It also helps build confidence among staff, ensures familiarity with the plan, and fosters a culture of preparedness. Now, CFPs must also be kept up to date. Markets evolve, business models change, regulators issue new guidance. A plan written 3 years ago and never updated is almost useless. Most banks review and refresh their CFP annually, or more frequently if there are significant changes. Now, this includes reviewing assumptions, updating contact lists, validating funding sources, and adjusting to new stress scenarios. Plans should be version controlled, board approved, and formally recorded. Now, regulatory expectations around CFPs have become increasingly detailed. In the UK, the PRA has issued clear guidance on what a good contingency plan must include, and supervisors review CFPs as part of the ILAAP process. They may ask firms to walk through the plan in a supervisory meeting, justify assumptions, or demonstrate how the plan aligns with stress testing results. Weaknesses in the CFP, such as unrealistic actions, vague governance, or untested assumptions, can lead to remediation requirements or additional supervisory scrutiny. The European Central Bank and national supervisors across the EU have similar expectations. Under the single supervisory mechanism, banks must show that their CFPs are operational, entity-specific, and executable under stress. This includes evidence of cross-border coordination, local currency strategies, and robust documentation. For international banks, this means ensuring that CFPs are not only consolidated at a group level, but also tailored at the legal entity level. The ability to execute a plan locally in a specific jurisdiction with locally available tools is a key test of credibility. Now, let's not forget that liquidity crises are rarely slow-moving. They often unfold over hours or days, not weeks. Now, the speed of response is critical. A good CFP reduces decision time by pre-authorizing actions, clarifying roles, and anticipating obstacles. It acts as a force multiplier, allowing a well-coordinated team to achieve more in less time, under more pressure. Now, that is the essence of contingency planning, creating clarity in a moment of chaos. To sum up, a strong contingency funding plan is the cornerstone of liquidity resilience. It's not just about compliance, it's about survival. It links the analytical side of liquidity risk with the practical realities of crisis management. It ensures that buffers are usable, tools are ready, people know what to do, and decisions can be made quickly. CFPs build trust with regulators, with markets, and within the firm. In our next session, we'll explore another key element of resilience: liquidity stress testing. We'll go beyond regulatory requirements to examine how banks design their own stress scenarios, calibrate assumptions, and use stress testing to guide real-world decisions. I'll see you in the next session. In the previous session, we explored contingency funding plans, the practical playbook for how a bank responds when liquidity stress hits. But what determines the scenarios that banks prepare for in those plans? How do they know what to expect, what might go wrong, and how bad it could get? Now, that's where liquidity stress testing comes into play. In this session, we're going to examine the role of stress testing in liquidity risk management. We'll look at how banks design stress scenarios, how they select assumptions, how they model outcomes, and how those outcomes feed into real-world decision-making. We'll also discuss regulatory expectations, model governance, and how stress testing fits into the wider risk management ecosystem. By the end of this session, you'll see how stress testing isn't just a regulatory exercise, it's a strategic tool for resilience, readiness, and resource planning. So let's start with the fundamental purpose of stress testing. The idea is simple: to evaluate how a bank's liquidity position would evolve under adverse but plausible conditions. Now, stress testing is about imagining the unexpected: loss of funding, rapid deposit withdrawals, market shutdowns, collateral calls, or ratings downgrades, and then quantifying their impact on the bank's liquidity profile. Now, when it's done well, stress testing helps a bank identify vulnerabilities, refine its risk appetite, guide contingency planning, and support the size and structure of its liquidity buffer. Now, stress testing also plays a key role in regulatory compliance. In the UK, the PRA expects banks to conduct robust internal liquidity stress testing as part of their ILAAP. And in the EU, the European Banking Authority provides detailed guidelines for liquidity stress testing under the SREP framework. Now, these expectations go beyond the standardized assumptions used in the LCR and NSFR. They require banks to develop their own internal scenarios that reflect their unique business models, funding structures, and risk profiles. Now, a typical liquidity stress testing framework includes a series of components: the scenario design, the behavioral assumptions, the data inputs, the modeling engine, the outputs and reporting, and the governance structure around all of the above. Now, let's walk through each of these in detail, starting with the scenario design. Now, banks typically develop a set of stress scenarios that fall into three broad categories: idiosyncratic stress, market-wide stress, and combined stress. And idiosyncratic stress involves a liquidity shock specific to the bank. For example, a sudden downgrade in its credit rating, negative media coverage, operational failure, or regulatory enforcement action. Now, these events could lead to higher funding costs, loss of counterparties, or deposit withdrawals specific to the bank rather than the market as a whole. Now, a market-wide stress assumes that broader financial markets are under pressure. Now, this could include a systemic banking crisis, a sovereign debt event, or a geopolitical shock. Now, in this scenario, all banks face similar stresses. Asset prices fall, funding costs rise, central bank actions become critical, and market liquidity dries up. So even strong banks may struggle to raise funding or monetize their assets. Now, a combined stress scenario brings the two together. Something specific to the bank occurs during a period of wider market disruption. Now, these are the most severe and are often used to calibrate the minimum liquidity buffer and contingency actions. Now, scenario design is both an art and a science. Scenarios must be severe enough to challenge the bank, but still plausible enough to be credible. They must be based on historical experience, market trends, and forward-looking judgment. For example, a scenario might include a 30% outflow of retail deposits over 10 days, a downgrade of 2 notches by rating agencies, and a 50% reduction in unsecured wholesale funding availability. Or it might assume increased haircuts on repo transactions, mass drawdowns of committed credit lines, or the failure of a key clearing counterparty. The goal is not to predict the future, but to explore the range of what could happen and how the bank would respond. The best stress testing programs use multiple scenarios across a variety of risk drivers, allowing management to compare results and assess the robustness of the liquidity position under different paths. Next comes the behavioural assumptions. Now, these are crucial as they drive how much funding is lost, how much liquidity is needed, and how fast the stress unfolds. Behavioural assumptions may include the percentage of corporate or retail deposits that are withdrawn under stress, the drawdown rate on undrawn committed facilities, the speed and extent of margin calls or collateral outflows, the usability of HQLA, including potential haircut increases or market liquidity, the refinancing rate of maturing wholesale debt, and the reaction of central banks or regulators to the stress. Now, these assumptions should be justified, documented, and regularly reviewed. They should be informed by historical data, peer benchmarking, supervisory feedback, and internal expert judgment. For example, during the COVID-19 crisis, many banks observed drawdowns of credit lines far beyond what their models had predicted. Now, that experience has since led to revisions in stress assumptions around contingent liquidity risk. Now, some firms also develop dynamic assumptions where behaviours evolve during the stress event. For instance, deposit outflows may accelerate if media coverage increases or if certain LCR thresholds are breached. Now, these dynamic features make models more realistic, but also more complex and more sensitive to model risk. Now, once the scenario and assumptions are defined, the next step is to run the model. Now, this is where banks use their liquidity forecasting engines to simulate daily cash flows, asset monetization, and funding availability under the stress scenario. Now, these tools typically generate things like liquidity gaps, so the difference between inflows and outflows over time, buffer usage, so how much of the HQLA is consumed and when, survival horizon, so the number of days the bank can continue to operate without new funding, and regulatory metric impact, so the projected path of LCR, NSFR, and other ratios under stress. Now, outputs must be granular, typically produced on a daily basis, and actionable, meaning they should feed into decision making. Now, the modelling must also cover multiple currencies, legal entities, and business lines, since liquidity is not always fungible across the organisation. Now, banks often define internal limits or triggers based on these stress test results. For example, they may require a minimum survival horizon of 30 days under a combined stress. Now, if a scenario shows a drop below that threshold, it may trigger management action, such as increasing the liquidity buffer, reducing asset growth, or tightening lending standards. Now, stress testing is also linked to risk appetite. The board may set risk appetite statements based on stressed outcomes. For example, the bank will maintain a minimum survival horizon of 45 days under a severe market-wide stress. Or no legal entity shall breach a 30-day stressed LCR under its idiosyncratic scenario. Now, these statements create clear boundaries for risk-taking and guide strategic decisions. Now, the outputs from stress testing are also used in the ILAAP, where banks must demonstrate their liquidity adequacy under adverse conditions. Supervisors will review the assumptions, methodologies, results, and how those results link to management actions. If stress testing reveals vulnerabilities that are not addressed in practice, regulators may impose additional requirements. From a governance perspective, model oversight is critical. Most banks have a liquidity stress testing committee or similar forum that reviews scenarios, approves assumptions, and monitors results. Now, models should be validated within independent teams, often within model risk management, and subject to regular review. Validation includes testing model logic, data integrity, and sensitivity to key inputs. Stress testing is also supported by data infrastructure. Reliable stress testing requires timely, accurate, and reconciled data across funding sources, asset holdings, off-balance sheet items, collateral positions, and contractual terms. Now, many banks struggle with data fragmentation, particularly in large international groups. So investing in robust data aggregation and reporting capabilities is essential for credible stress testing. Now, an emerging trend in liquidity stress testing is the use of reverse stress testing. Now, this starts with a defined failure point, such as LCR dropping below 100% or survival horizon hitting zero, and works backwards to identify what sequence of events could cause that outcome. Now, this helps identify tail risks, correlations, and structural weaknesses that might not emerge in forward-looking scenarios. Another trend is the integration of climate risk and ESG factors into stress testing. For example, a bank may simulate a disorderly transition scenario in which carbon-intensive borrowers face funding constraints, regulatory sanctions, or reputational damage. Now, this can affect funding availability, client behavior, and collateral values, creating liquidity implications that traditional stress testing might miss. Now, some banks are also exploring real-time or near real-time stress testing using advanced analytics and AI tools. These allow stress testing to move from a quarterly or monthly exercise to a dynamic, scenario-driven tool that supports daily decision-making. For example, the impact of a sudden geopolitical shock or a market rumour can be modelled instantly, allowing faster and more informed responses. Importantly, stress testing is not just a back-office function. Its results must be discussed at senior levels, including ALCO and the board. Now, management must understand the scenarios, challenge the assumptions, and own the outcomes. Stress testing should not be a black box. It should be a living process that supports judgment, planning, and resilience. Now, to summarise, liquidity stress testing is one of the most powerful tools in a bank's liquidity risk arsenal. It allows firms to explore the impact of severe shocks, to test their readiness, and to make better decisions under uncertainty. It connects data with judgment, modelling with governance, and risk awareness with strategic planning. In a world of rising complexity and interconnected risks, stress testing helps banks stay one step ahead. In our next session, we'll turn our attention to the heart of daily liquidity operations, the Treasury function. We'll explore how Treasury teams manage liquidity buffers, execute funding strategies, interact with markets, and support both business and regulatory objectives. I'll see you in the next session. In our previous sessions, we've explored liquidity from many angles: regulatory metrics, pricing frameworks, stress testing, and contingency planning. But while those topics often deal with policies, models, and assumptions, Liquidity is also a real-time, day-to-day business. At the heart of that business sits the Treasury function. Treasury is where liquidity is watched, managed, moved, and optimized minute by minute, hour by hour. It's the operational core of liquidity risk management. So in this session, we're going to explore what Treasury does, how it operates, and how it fits into the broader risk and finance structure. We'll look at how Treasury manages cash, funding, and liquidity buffers, how it interacts with internal stakeholders and external markets, and what systems and controls it uses to navigate the complexity of modern banking. By the end of this session, you'll have a clear understanding of the Treasury function, not just what it is, but why it's so essential to keeping a bank liquid and resilient. So let's begin with the basic mandate of Treasury. Now, Treasury is responsible for managing the bank's liquidity, funding, capital markets activity, and often its interest rate risk and currency positions. Now, while exact responsibilities vary by institution, Treasury is always the central player when it comes to ensuring the bank has enough cash to meet its obligations in the right currency, at the right time, and in the right place. It serves as both a service provider and a control function, supporting the business lines with funding while safeguarding the institution's liquidity profile. Now, one of Treasury's core responsibilities is liquidity buffer management. Now, this means ensuring that the bank holds an adequate stock of high-quality liquid assets. Assets that can be quickly converted into cash to meet short-term obligations. Now, these buffers support regulatory metrics like the liquidity coverage ratio, but they also provide operational flexibility and crisis resilience. Now, Treasury monitors the composition, location, and usability of the buffer on a daily basis. Assets must be unencumbered, correctly classified, and appropriately diversified. The team also considers market conditions, because liquidity is not static, and what's highly liquid today may become harder to sell tomorrow. Now, buffer management involves not only holding the right assets, but also maintaining operational readiness. Now, that includes ensuring that repo facilities are available, counterparties are approved, and collateral can be mobilized efficiently. Now, many Treasury teams maintain monetization ladders or liquidity waterfalls, which are predefined sequences of how assets will be used in a stress event, balancing speed, market impact, and cost. Now, this preparation ensures that the buffer is not just theoretical, but genuinely usable. Another central role of Treasury is cash and intraday liquidity management. Now, every day, banks process vast volumes of payments, customer transactions, security settlements, margin calls, and interbank transfers. Now, Treasury ensures that cash is available where and when it's needed, avoiding payment failures, overdrafts, or reputational risks. Now, this involves forecasting intraday flows, monitoring real-time balances, and coordinating with business units and operations teams. Treasury also manages central bank accounts and access to liquidity facilities. So in many systems, such as the Bank of England's RTGS, which is the real-time gross settlement infrastructure, banks must maintain sufficient balances to meet settlement obligations throughout the day. Now, Treasury ensures that these balances are topped up, collateral is in place, and systems are functioning accordingly. Now, in times of stress, intraday liquidity can become just as important as the end-of-day liquidity, and Treasury must act fast to resolve blockages. Now, when it comes to funding strategy, Treasury plays a strategic and tactical role. Strategically, Treasury plans the bank's funding profile. So how much to raise, in what tenors, in which currencies, and through which instruments. Now, this includes issuing bonds, raising deposits, accessing secured funding like repos or covered bonds, and engaging with wholesale counterparties. Now, Treasury must align funding plans with the asset strategy, regulatory requirements like the NSFR, and market conditions. Now, this planning is typically captured in the bank's annual funding plan, which is reviewed by ALCO and approved by the board. Now, tactically, Treasury executes funding transactions, prices internal and external funding, and manages short-term liquidity flows. On any given day, Treasury may need to raise overnight cash, roll maturing deals, or rebalance funding across currencies. These actions are guided by liquidity forecasts, regulatory targets, market conditions, and internal pricing signals. Speed and precision are essential. The Treasury desk may operate as a central hub with visibility over cash positions across the bank and authority to direct or allocate funding accordingly. Treasury is also responsible for contingency liquidity readiness. Now, this means maintaining access to emergency funding sources such as central bank facilities or backup lines with counterparties. It involves pre-positioning collateral, ensuring legal agreements are in place, and rehearsing operational procedures. Now, in a liquidity crisis, Treasury is on the front line, executing contingency actions, managing liquidity calls, and liaising with regulators and central banks. Another important function of Treasury is its role as the internal bank. Now, through funds transfer pricing, Treasury intermediates between the business units that generate funding and those that use it. It sets internal funding rates, allocates liquidity costs, and manages balance sheet structure. Treasury ensures that funding incentives align with risk appetite and strategy. If the bank wants to lengthen its liability profile, Treasury can do this by increasing the internal cost of short-term funding. If it wants to encourage more retail deposits, it can increase the credit to deposit businesses. Treasury also plays a key role in asset liability management, or ALM for short. Now, this includes managing interest rate risk in the banking book, foreign exchange exposures, and structural mismatches in the balance sheet. In some banks, ALM sits within Treasury. In others, it's a separate but closely linked function. Together, they ensure that the bank remains stable and profitable across interest rate cycles, funding environments, and business growth phases. Now, the interaction between Treasury, risk, and finance is critical. Risk provides oversight, so reviewing Treasury's activities, monitoring limit usage, and challenging assumptions. Finance provides the data, forecasts, and accounting inputs needed for liquidity planning and reporting. Now, the three functions must work together to align liquidity management with strategic and regulatory objectives. Effective Treasury teams are deeply integrated into ALCO, ILAAP, stress testing, and recovery planning processes. Externally, Treasury teams interact with a wide range of stakeholders. Now, these include central banks, which provide operational accounts and liquidity facilities, regulators who receive liquidity reports and conduct supervision, investors who buy the bank's debt or equity, and counterparties who provide market funding or transact in derivatives. Treasury must maintain strong relationships, transparent communication, and robust operational infrastructure to manage these interactions effectively. Now, technology is increasingly important to Treasury operations. Modern Treasury functions rely on liquidity dashboards, cash forecasting engines, collateral management platforms, and automated dealing systems. Real-time data is essential for making informed funding decisions, managing risk, and meeting regulatory requirements. As liquidity risk becomes more dynamic and interconnected, technology investment becomes a competitive necessity. Now, Treasury is also at the forefront of regulatory compliance. The team is typically responsible for producing or supporting liquidity reports such as the LCR, NSFR, PRA 110 in the UK, and similar templates in the EU. Now, these reports require detailed, high-frequency data across products, currencies, and legal entities. Treasury must ensure that data is accurate, reconciled, and submitted on time. Errors or late submissions can trigger supervisory action or damage the bank's reputation. Now, operational resilience is another key concern. Treasury must be able to function under stress, whether that's a market crisis, a cyber event, or a systems outage. Many banks now operate Treasury resilience frameworks, including backup sites, remote access protocols, dual authorization systems, and crisis communications plans. Now, these frameworks are tested regularly and reviewed by internal audit and regulators. Now, one challenge Treasury teams face is balancing profitability with safety. Now, Treasury is often expected to manage liquidity prudently while also contributing to the bottom line through interest rate positioning or funding optimization. Now, this requires careful governance, clear mandates, and alignment within risk appetite. Treasury is not a profit centre in the traditional sense, but its actions have significant impact on the bank's financial performance. Now, Treasury's role continues to evolve. In recent years, it's become more strategic, supporting growth, capital planning, and even sustainability goals. For example, Treasury may issue green bonds, develop ESG-aligned funding strategies, or support business lines with ESG-linked pricing. As banks respond to new challenges such as climate risk, digital disruption, geopolitical shifts, Treasury is being asked to do more with greater speed and sophistication. To summarise, the Treasury function is the operational engine of liquidity management. It keeps the bank running on a daily basis, ensures compliance with regulatory standards, and acts as the first responder in times of stress. It bridges the gap between funding and strategy, between market conditions and internal decisions. It requires skill, precision, coordination, and resilience. In our next session, we'll explore the market side of liquidity. So how banks raise and deploy funding across instruments, currencies, and counterparties. We'll look at unsecured funding, secured funding, repo markets, and capital market activity, and how these interact with liquidity planning and regulatory expectations. I'll see you in the next session. In our last session, we focused on the Treasury function and how it manages liquidity on a day-to-day basis. We saw how Treasury is responsible for monitoring buffers, overseeing funding flows, and ensuring the bank is operationally equipped to meet its liquidity needs. Now it's time to zoom in on one of the most critical parts of Treasury's role: accessing funding markets. In this session, we'll explore the instruments and mechanisms banks use to raise funding, how they operate in secured and unsecured markets, how they manage maturities and pricing, and how they interact with counterparties and investors. We'll also look at the strategic considerations behind funding structure, diversification, and market presence. By the end of this session, you'll understand how banks move money in and out of the institution through capital markets and why effective access to funding is foundational to liquidity resilience. So let's begin with an overview of two primary categories of funding: secured and unsecured. Now, these terms refer to whether the borrowing is backed by collateral or not. In unsecured funding, the lender provides funds purely based on the creditworthiness of the borrowing bank. Now, common examples include deposits from corporates and financial institutions, interbank loans, and the issuance of debt instruments such as commercial paper, certificates of deposit, and senior unsecured bonds. Now, in secured funding, the borrowing is backed by specific assets pledged as collateral. Now, this includes repo transactions, covered bonds, and central bank operations. Now, unsecured funding plays a vital role in bank funding, especially in the short to medium term space. Corporate and financial institution deposits can be a major source of funding, often more volatile than retail deposits, but useful due to their scale and flexibility. Now, Treasury teams carefully monitor the composition, maturity, and behavioural stability of these deposits. Larger institutional clients, such as asset managers or corporates with operational accounts, may provide stable balances, but others, particularly if uninsured or yield sensitive, may move quickly if conditions deteriorate. Now, to diversify beyond deposits, banks also issue money market instruments like commercial paper and certificates of deposit. Now, these are short-term securities, typically issued with maturities ranging from a few days to a year, that offer investors a low-risk, liquid investment. Commercial paper is usually unsecured, while certificates of deposit may offer slightly different structures or terms depending on the jurisdiction. Now, these instruments are actively traded in secondary markets, providing the bank with flexibility and access to a broad investor base. For longer-term funding, banks issue senior unsecured bonds. Now, these can be fixed or floating rate, issued in various currencies, and structured to appeal to institutional investors such as pension funds, insurance companies, or asset managers. Senior bonds rank high in the capital structure, meaning they're paid before subordinated debt or equity in the event of default. Now, these instruments help meet the NSFR by providing longer-dated, stable liabilities. They also signal credit strength to the market, which can help reduce overall funding costs. In addition to senior bonds, banks may issue subordinated debt, such as Tier 2 capital instruments or additional Tier 1 AT1 bonds, which serve both capital and funding purposes. While more expensive due to their higher risk profile, these instruments allow banks to meet regulatory capital requirements while raising funding. Now, the choice to issue subordinated debt depends on the bank's capital structure, investor appetite, and pricing conditions. Now let's look at secured funding, which is equally important, particularly for managing short-term liquidity. Now, the most common form of secured funding is the repurchase agreement, or repo for short. In a repo transaction, the bank sells securities, typically high-quality liquid assets, to a counterparty, with an agreement to repurchase them at a later date, usually at a slightly higher price. Now, the difference in price represents the interest on the loan. Now, repos are widely used to raise short-term cash and are seen as lower risk by lenders thanks to the collateral involved. Now, the repo market is large, it's liquid, and highly technical. Pricing is driven by collateral type, term, counterparty risk, and broader market conditions. Now, during stress periods, repo haircuts may increase, meaning banks have to pledge more collateral for the same amount of funding, and counterparties may become more selective. Effective management of repo lines and eligible collateral is therefore essential. Many Treasury teams run collateral optimization models, which ensure that the best suited assets are used in each repo transaction, minimizing cost and preserving flexibility. In addition to repos, banks also issue covered bonds. Now, these are debt instruments secured by a pool of high-quality assets such as residential mortgages or public sector loans. The key difference between covered bonds and securitizations is that the assets remain on the bank's balance sheet and investors have dual recourse, so both to the underlying asset pool and to the bank itself. Now, covered bonds are popular in Europe and are seen as highly secure by investors, often attracting favorable regulatory treatment. They offer longer-term funding and are an important part of many banks' funding strategies. Securitization is another form of secured funding. Now, in this model, banks pool assets such as mortgages or auto loans and transfer them to a special purpose vehicle which issue asset-backed securities to investors. The bank receives upfront cash in exchange for the future cash flows of the assets. Now, securitization can be a powerful funding tool, allowing banks to transfer risk and access new investor pools. However, it comes with greater complexity, regulatory scrutiny, and operational requirements. Central banks also provide secured funding, typically through standing facilities or open market operations. For example, the Bank of England offer indexed long-term repo operations and other liquidity schemes. Banks can pledge eligible collateral, often government securities or top-rated assets, in exchange for cash. Now, these facilities are not just for crisis moments, they're also used to manage seasonal flows, collateral availability, and short-term mismatches. Now, having access to these facilities with pre-positioned collateral and tested procedures is a key part of liquidity resilience. Now, the choice between secured and unsecured funding is strategic. Secured funding is generally cheaper and more stable, particularly in times of market stress, but it comes at the cost of collateral, which must be managed carefully. Unsecured funding is more flexible and scalable, but often more expensive and more sensitive to credit perception. Most banks aim for a balanced mix, diversifying across sources, tenors, instruments, and investor types. Now, this leads us to the concept of funding diversification. One of the most important principles in liquidity risk management is not to rely too heavily on any single source or channel of funding. A bank with a concentrated funding base, such as a heavy reliance on short-term wholesale deposits or one dominant investor group, is inherently more vulnerable. Treasury teams track concentration metrics, set internal limits, and report exposures to ALCO and regulators. Diversification covers currency, maturity, counterparty, and instrument type. Now, currency is particularly important. A bank operating in multiple markets must fund itself in multiple currencies. Now, foreign exchange swaps, cross-currency repos, and multi-currency bond issuance are tools used to manage this. Now, currency mismatches introduce additional risks, including basis risk and convertibility concerns, which must be managed within the bank's liquidity and market risk frameworks. Regulatory regimes increasingly expect currency-specific liquidity metrics, not just consolidated views. Now, maturity diversification is equally crucial. Banks avoid having funding cliffs where large volumes of debt mature at once. Treasury teams stagger maturities across different time buckets and geographies, creating a smooth funding profile. Tools like funding maturity ladders help visualize and manage these exposures. Now, from a strategic perspective, market access is everything. A bank's ability to raise funding at reasonable cost depends on its credit rating, investor relationships, regulatory standing, and reputation. Now, Treasury teams engage actively with investors through roadshows, issuance updates, and feedback sessions. Investor relations and Treasury must work hand in hand to maintain transparency, deliver credible funding plans, and respond quickly to changes in sentiment. Now, regulatory requirements also influence market activity. The NSFR creates incentives to issue longer-term funding. The LCR encourages the use of certain instruments over others. Capital planning, recovery and resolution frameworks, and systemic risk buffers all feed into funding decisions. Treasury teams must balance these constraints with pricing, market dynamics, and internal business needs. Now, post-crisis reforms have also introduced new tools for planning and supervision. In the UK, the PRA 110 reporting template captures granular funding data, helping supervisors understand banks' reliance on different sources. In the EU, similar templates exist under the European Banking Authority's guidelines. Now, these reports help detect vulnerabilities early and feed into supervisory dialogues. It's also important to consider market readiness during times of stress. In a crisis, unsecured markets may freeze, repo haircuts may spike, and central bank facilities may become the only available option. Banks must therefore maintain access to these channels, build redundancy into funding plans, and test operational readiness. Treasury stress tests include assumptions about market shutdowns, repo gridlocks, and counterparty withdrawals. Now, one interesting development in funding strategy is the rise of green and sustainable funding instruments. Many banks now issue green bonds, social bonds, or sustainability-linked instruments. These products attract ESG-focused investors and support broader strategic objectives. Treasury teams must work closely with sustainability functions to structure these instruments appropriately, align with frameworks such as the ICMA Green Bond Principles, and provide transparent reporting on use of proceeds. So to summarize, accessing funding markets is at the heart of liquidity risk management. Banks must navigate a complex landscape of instruments, counterparties, regulations, and market dynamics. The key is to maintain flexibility, diversification, and credibility. Treasury teams are the stewards of this process, executing funding strategies that support resilience, regulatory compliance, and business growth. In our next session, we'll explore how liquidity risk management plays out across international operations. We'll look at how banks manage liquidity in a cross-border context, how they deal with ring fencing, fragmentation, and jurisdictional challenges, and how they maintain resilience across legal entities and currencies. I'll see you in the next session. Up until this point, we've mainly explored liquidity risk management from a consolidated, group-level perspective. We've discussed buffers, funding markets, contingency plans, and regulatory ratios, with the implicit assumption that the bank is a single entity managing liquidity as one integrated pool. But in reality, most large banks operate across multiple jurisdictions, legal entities, currencies, and regulatory regimes. Now, this creates a whole new set of challenges. In this session, we're going to focus on cross-border liquidity management. how banks handle liquidity fragmentation, regulatory ring fencing, currency mismatches, and operational coordination across geographies. We'll explore how group-level oversight can be maintained without breaching local requirements, and how firms manage liquidity effectively across a globally distributed footprint. By the end of this session, you'll have a clear picture of why cross-border liquidity is both essential and complex, and how institutions can strike the right balance between centralization and local resilience. So let's begin by understanding the core issue. Liquidity is not always fungible. Now, while capital can often be allocated or moved freely across a banking group, liquidity is subject to a range of constraints. Now, these may include regulatory restrictions, legal entity boundaries, currency controls, local funding practices, tax implications, and operational infrastructure limitations. Now, the result is what we call liquidity fragmentation, the phenomenon where liquidity becomes trapped or siloed in parts of the group, reducing the effectiveness of the overall buffer. One of the biggest contributors to this fragmentation is regulatory ring fencing. After the global financial crisis, regulators in many jurisdictions introduced rules to ensure that local banking entities could survive stress independently of their parent groups. Now, the idea was to protect domestic financial systems from contagion caused by foreign bank failures. Now, these measures include requirements to maintain local liquidity buffers, limits on intragroup flows, and restrictions on upstreaming cash or collateral to the parent company. For example, a UK subsidiary of a global bank must comply with the PRA's liquidity rules, including maintaining its own LCR, demonstrating standalone resilience under stress, and submitting detailed reports via the PRA 110 template. It cannot assume unrestricted support from its parent, and any intragroup funding agreements must be operationally and legally robust. The same is true in the EU under the single supervisory mechanism, where subsidiaries must comply with local regulatory expectations set by the ECB or national authorities. In the US, the Federal Reserve requires large foreign banking organizations to establish intermediate holding companies, or IHCs for short, and hold sufficient liquidity at the local level. Similar requirements exist in Australia, Canada, Singapore, and elsewhere. Now, each jurisdiction wants to ensure that local customers, markets, and obligations can be serviced regardless of what's happening at the group level. Now, this has profound implications for how banks manage liquidity globally. Group-level buffers may not be deployable in practice. A parent company may have excess liquidity, but its subsidiary in another country may not be able to access it due to local restrictions. Now, this leads to the need for entity-level liquidity management, where each material legal entity maintains its own liquidity position, its own buffer, governance, and contingency plans. Now, Treasury functions must therefore operate in a dual structure: centralized oversight with decentralized execution. Group Treasury sets global policy, monitors consolidated risk, and allocates resources. Local Treasury teams manage day-to-day liquidity within the parameters of their jurisdiction. Now, this includes monitoring local LCR and NSFR, executing funding in local markets, engaging with local regulators, and preparing for local stress scenarios. Now, communication and coordination between group and entity-level teams is essential. This is often achieved through regional Treasury hubs, liquidity councils, and cross-entity reporting structures. Group Treasury may require daily or weekly updates from local entities on liquidity positions, funding plans, and risk metrics. Local teams, in turn, rely on the group for strategic funding, pricing curves, and access to shared tools or models. Now, one key challenge in this structure is the management of intra-group funding flows. These are the internal loans, deposits, or repo transactions between legal entities of the same group. Intergroup funding is a critical tool for allocating liquidity across the organisation, but it must be carefully managed to comply with legal, regulatory, and operational requirements. Now, banks typically use intergroup funding agreements, which are legal contracts defining the terms, the pricing, and limits of liquidity flows between entities. Now, these agreements must be enforceable under stress and tested regularly. Now, regulatory scrutiny of intergroup arrangements has increased significantly, with authorities asking banks to demonstrate that such flows can be executed in a timely, transparent, and legally binding way. If not, regulators may disallow the inclusion of these flows in the LCR or NSFR calculations, reducing their effectiveness. Now, intergroup flows also create counterparty exposures, which must be monitored for credit and capital implications. The transfer pricing mechanisms must reflect appropriate risk premiums, and collateral arrangements may be required in some cases. Now, some regulators place hard limits on the size of intergroup exposures, particularly between systemic entities or across borders. Currency risk adds another layer of complexity. Now, banks operating in multiple currencies must manage liquidity in each major currency, not just in aggregate. Funding raised in one currency cannot always be used to meet obligations in another. Foreign exchange markets may be disrupted during a crisis and convertibility can become constrained. And because of this, regulators often require banks to monitor currency-specific LCRs, stress test FX liquidity, and ensure access to central bank swap lines or local FX markets. To manage this, Treasury teams use a mix of foreign exchange swaps, cross-currency repos, and multi-currency bond issuance. FX swaps allow banks to temporarily convert one currency into another, typically exchanging notional amounts and reversing them later. Cross-currency repos involve pledging collateral in one currency in exchange for cash in another. Now, these instruments are useful, but they require available counterparties, functioning markets, and appropriate collateral. Now, during stress, their reliability may decline. Banks also maintain currency-specific liquidity buffers, ensuring that each major currency has enough high-quality liquid assets to meet projected outflows. This often means holding sovereign bonds, reserves, or central bank eligible assets in local jurisdictions. Now, these buffers must be ring-fenced, tracked, and reported separately, adding operational and analytical complexity. Now, cross-border liquidity management also involves recovery and resolution planning. Regulators require banks to demonstrate how they would respond to severe stress scenarios, including the failure of one or more legal entities. Recovery plans must show how liquidity would be preserved or reallocated within the group. So resolution plans must demonstrate that critical functions can continue without disrupting local financial stability. Liquidity plays a central role in these plans, especially for systemically important institutions. One approach used by many banks is the self-sufficiency with support model. Now, this means each legal entity is expected to be resilient on a standalone basis, but can receive support from the group when needed, under predefined conditions. Now, this balances regulatory expectations with group-level efficiency. In practice, this model requires careful calibration of buffers, legal agreements, and operational readiness. Another emerging approach is the pre-positioning of collateral and liquidity. This means ensuring that assets are already located in the right place, in the right currency, and with the right legal access before stress hits. Banks increasingly invest in systems that allow them to track and optimize collateral location, eligibility, and usage across the group. This supports faster execution of contingency actions and reduces reliance on post-crisis transfers. Cross-border liquidity also has a technology and data dimension. To manage liquidity globally, banks need integrated systems that can capture positions, flows, and risks across currencies, entities, and products. They need real-time dashboards, automated reporting, and scenario analysis tools that allow group and entity teams to share insights, respond to changes, and coordinate actions. Manual processes or fragmented systems create delays and reduce visibility, especially during fast-moving stress events. And governance is equally important. Global banks typically establish liquidity management committees at both group and regional levels, with clear terms of reference, reporting lines, and escalation procedures. These committees monitor key metrics, review funding plans, oversee intergroup flows, and manage stress scenarios. They also serve as the interface with supervisors, ensuring that the bank can explain and justify its approach across jurisdictions. To support this, firms maintain cross-border liquidity policies that define the principles for allocation, monitoring, and contingency planning. These policies are reviewed by the board, shared with regulators, and embedded in internal training. They ensure consistency while allowing for local flexibility. To summarise, cross-border liquidity management is a complex but essential discipline. It requires balancing central control with local autonomy, integrating data and systems, managing multiple currencies and counterparties, and navigating a patchwork of regulatory expectations. When it's done well, it allows global banks to operate efficiently, respond quickly to stress, and maintain trust with regulators and markets across the world. In our next session, we'll shift focus from structure to strategy, looking at liquidity planning and forecasting. We'll examine how banks anticipate liquidity needs over different time horizons, how they integrate business strategy with funding needs, and how they build robust forecasts in an uncertain world. We'll explore how forward-looking planning turns liquidity risk from a reactive challenge into a proactive opportunity. I'll see you in the next session. In our last session, we explored the complexities of managing liquidity across borders, dealing with fragmentation, ring-fencing, and regulatory variation. It was a reminder that managing liquidity isn't just about keeping score, it's about being prepared. Now that theme continues in this session, where we turn our attention to one of the most vital, forward-looking tools in a bank's liquidity toolkit: liquidity planning and forecasting. In this session, we'll explore how banks anticipate their future liquidity needs across different time horizons, how they connect liquidity forecasts to business strategy and market dynamics, and how they balance flexibility, realism, and control in planning processes. By the end, you'll see how good liquidity planning does more than prevent crisis. It helps a bank grow confidently and sustainably. So let's begin by understanding the purpose of liquidity planning. Now, at its heart, liquidity planning is about anticipating the future state of the bank's liquidity profile, so the firm can prepare for both expected needs and unexpected shocks. It's about ensuring that as the bank grows, launches new products, takes on new risks, or responds to external events, it always retains enough flexibility and funding resilience to adapt without panic or disruption. Now, liquidity planning operates across multiple time horizons. The shortest time horizon is intraday, where Treasury ensures payments and settlements are made smoothly throughout the business day. Next is short term, typically the next 1 to 30 days, which is where metrics like the LCR and cash flow forecasting models are focused. Then comes medium term, often covering the 1 to 3 month window, where banks assess funding rollovers, maturing debt, and short-term investments. And finally, there's the long-term horizon, spanning 3 months to 1 year and beyond, which aligns closely with NSFR compliance, business strategy, and structural planning. Now, each of these horizons requires a different approach, different data, and different tools, but they must all be connected through a coherent liquidity planning framework. Now, at the center of that framework is the liquidity forecast, a model that projects expected inflows and outflows of cash under business as usual conditions over different time periods and with varying levels of granularity. Now, liquidity forecasts are typically built from the ground up. They start with known contractual cash flows, such as maturing loans, deposits, debt repayments, and coupon payments, and then overlay behavioral assumptions, planned balance sheet activity, and expected business growth. For example, a bank might forecast that 200 million of corporate term deposits will mature next week, but expects only 150 million will roll over based on past behavior and market conditions. It might expect to disperse 300 million of new mortgage loans in the next month, which will reduce liquidity but increase asset balances. Now, these forecasts must be updated regularly, daily for short-term windows, weekly or monthly for longer-term horizons. Now, the quality of a liquidity forecast depends heavily on the underlying data. Now, that includes core banking system data, treasury systems, customer behavior models, product level cash flow schedules, and market assumptions such as interest rates or FX trends. Many banks use dedicated forecasting platforms that pull data from multiple sources, reconcile positions, and produce scenario-based outputs. Now, these platforms allow Treasury and risk teams to visualize liquidity gaps, test what-if cases, and track changes over time. A strong forecast doesn't just track cash, it anticipates drivers of change. Now, that includes planned issuance of debt, customer deposit flows, seasonal lending peaks, expected dividend payments, and corporate actions. It also includes regulatory requirements, such as maintaining minimum buffers or meeting internal liquidity targets. Some forecasts include contingency assumptions, allowing users to toggle between base case, stressed, and crisis scenarios. For example, toggling a button may assume a 10% deposit outflow or a delay in wholesale refinancing. Now, liquidity planning also requires alignment with the bank's strategic plans. This means integrating liquidity forecasts with business forecasts so that asset growth, customer activity, and new initiatives are matched by appropriate funding strategies. Now, Treasury must work closely with finance, strategy, and business units to ensure that plans to expand lending, invest in new markets, or launch new products are reflected in the liquidity planning cycle. For example, if a bank's retail business plans to grow mortgage lending by 20% over the next 12 months, Treasury needs to assess whether the existing funding structure can support that growth. Will deposits be sufficient? Will new bond issuance be needed? Will the change affect LCR or NSFR compliance? These questions are answered through integrated planning processes, often tied to the bank's annual budget and capital planning cycle. Now, in many institutions, this is formalized through a liquidity planning committee, a subgroup of ALCO, or as part of the annual ILAAP process. The committee reviews forecasts, sets internal liquidity targets, approves funding strategies, and monitors performance. Now, liquidity plans are reviewed quarterly or semi-annually, and major assumptions such as behavioral profiles, market capacity, and contingency tools are subject to independent challenge. A common tool used in liquidity planning is the Maturity Mismatch Report, also known as a liquidity gap report. This shows expected cash inflows and outflows across defined time buckets, say daily for the first week, weekly for the first month, and then monthly thereafter. The gaps can be positive, i.e. a surplus of cash, or negative, i.e. a need for funding. Now, these reports help Treasury visualize pinch points, plan actions, and allocate buffers accordingly. Many firms produce gap reports by currency and legal entity to capture the impact of fragmentation and local market dynamics. Another essential element is the funding plan. Now, this is a formal document that sets out how the bank intends to meet its funding needs over a 12 to 18-month horizon. It includes targets for debt issuance, expected changes in deposit balances, planned use of repo or central bank facilities, and contingency arrangements. The funding plan is aligned with the liquidity forecast and is submitted to regulators in many jurisdictions, including the UK and EU. It's often reviewed by the board and shared with rating agencies and investors. Funding plans also cover market access assumptions. For example, how much the bank expects to issue in the senior unsecured market, what tenors are targeted, what currencies will be used, and which investor segments are being approached. These assumptions are informed by market conditions, historical issuance data, and dialogue with investors. The plan may also include plans for green or ESG labelled issuance, aligning with broader sustainability strategies. Now, stress scenarios are often embedded into liquidity planning. For example, what if wholesale markets are closed for a month? What if a large deposit client withdraws 50% of their balance? What if the bank is downgraded by 2 notches? Forecasts can be adjusted to simulate these outcomes, allowing Treasury and risk teams to plan actions in advance, such as increasing buffer size, slowing asset growth, or shifting funding mix. Some banks take liquidity planning a step further by integrating it with capital planning and recovery planning. Now, this is often referred to as integrated balance sheet management. The idea is that liquidity, capital, and earnings are interdependent and must be planned together. For example, issuing more long-term debt to improve NSFR may impact the net interest income. Growing assets may require more capital and more liquidity. Recovery actions, such as selling assets or cancelling dividends, must be assessed for their impact on liquidity and funding. Now, technology plays an increasingly important role in planning and forecasting. Leading banks use AI and predictive analytics to model deposit behaviour, market trends, and funding costs. They simulate forward curves, volatility scenarios, and even behavioural changes in customer activity. They integrate forecasts into dashboard tools, allowing Treasury and ALCO to monitor key metrics in real time and drill into drivers. Now, these tools support faster, more informed decisions and reduce reliance on static spreadsheets or manual aggregation. Another development is cloud-based planning platforms, which allow distributed Treasury teams across regions and legal entities to collaborate on a single liquidity view. This is especially valuable for cross-border banks, where entity-specific planning must be rolled up to a group level. These platforms also support automated reporting, audit trails, and scenario comparisons. And as always, governance is key. Good liquidity planning requires clear ownership, well-documented assumptions, and regular challenge. Treasury owns the forecast, but inputs come from across the bank. Finance, risk, business units, and even compliance. Assumptions must be reviewed regularly, stress-tested, and adjusted as needed. And it goes without saying that the board and senior management must be engaged in the planning process, not just presented with the outputs. Planning is not just about numbers, it's about insight, alignment, and readiness. And finally, it's worth noting that liquidity planning is not just a defensive tool, it's also an enabler of growth. A bank with strong liquidity planning can launch new products more confidently, enter new markets more effectively, and respond to opportunities faster than its peers. It can signal stability to regulators, investors, and clients. It can absorb shocks more easily and manage uncertainty with greater control. To summarize, liquidity planning and forecasting sit at the heart of proactive liquidity risk management. They turn compliance into capability, risk into readiness, and numbers into strategy. They connect the present to the future and allow banks not just to survive, but to succeed. In our next session, we'll begin to look outward at the future of liquidity management in a changing world. We'll explore how emerging technologies like artificial intelligence, digital currencies, and real-time settlement systems are transforming liquidity risk and treasury operations. I'll see you in the next session. Up until now, we've covered the foundations of liquidity risk management, the structures, processes, models, and strategies that banks use to monitor, manage, and prepare for liquidity challenges. But the financial world is changing fast. New technologies are emerging, market infrastructure is evolving, and regulatory priorities are shifting to reflect a more digital, interconnected, and real-time environment. In this session, we'll turn our attention to the future. We'll explore how artificial intelligence, central bank digital currencies, and real-time payment systems are set to reshape liquidity management. We'll look at the opportunities these developments create, the risks they introduce, and how banks can prepare to adapt. By the end of this session, you'll have a forward-looking perspective on what's coming next in the world of liquidity risk. So let's start with artificial intelligence and machine learning. Now, AI is already beginning to transform areas like fraud detection, credit risk modeling, and customer analytics. But its impact on liquidity management is just beginning to be felt. One of the most immediate applications of AI in this space is in the liquidity forecasting and cash flow modeling space. Traditional forecasting methods rely on static assumptions and historical averages. AI, by contrast, can ingest vast amounts of data across transactions, customer behavior, market activity, and macroeconomic indicators and identify patterns that human analysts might miss. For example, AI tools can detect early signs of deposit volatility by analyzing behavioral signals, such as changes in login patterns, mobile app usage, or transaction types. Now, these insights can feed into the dynamic forecasting models, allowing Treasury to anticipate liquidity needs days or even weeks ahead of time with greater accuracy. Now, in the same way, AI can optimize the allocation of liquidity across business lines and legal entities by modeling usage patterns, funding costs, and asset liquidity under various conditions. Now, another area where AI adds value is scenario modeling. Instead of relying on a handful of predefined stress tests, AI can simulate thousands of potential paths using Monte Carlo methods or reinforcement learning techniques. Now, these simulations can highlight rare but plausible risk events, such as simultaneous shocks to funding, market liquidity, and collateral requirements. They can also uncover correlations between risk drivers that traditional models might treat as independent. Now, natural language processing, or NLP for short, another branch of AI, is also being used to monitor news feeds, market chatter, and social media for liquidity, which are all relevant signals. For example, if sentiment around a bank or a sector suddenly turns negative, AI can detect this in real time and trigger alerts for Treasury and risk teams. Now, while not yet widely deployed, these technologies offer an additional layer of situational awareness, particularly in a world where market confidence can shift in seconds. Of course, the use of AI brings its own challenges. Models must be explainable, auditable, and aligned with regulatory expectations. Many regulators, especially in the UK and EU, are cautious about the use of black box algorithms in risk-sensitive areas. Banks must ensure that AI-driven forecasts or decisions are interpretable, tested, and subject to governance controls. This includes documentation, validation, and alignment with existing model risk frameworks. There is also the question of data privacy and ethical use, particularly when customer data is involved. Despite these challenges, the direction of travel is clear. AI will become increasingly embedded in liquidity risk infrastructure, particularly in forecasting, optimization, and early warning. The banks that invest early in responsible, well-governed AI will have a competitive edge, not just in managing risk, but in allocating capital more effectively and seizing opportunities with greater confidence. Now, let's turn our attention to central bank digital currencies, or CBDCs for short, arguably one of the most talked about developments in global finance. Now, CBDC is a digital form of central bank money, like cash, but issued and settled electronically, often in real time. Several jurisdictions are experimenting with CBDCs or considering launching them, including the Bank of England with its Digital Pound Initiative and the European Central Bank with its Digital Euro exploration. CBDCs raise fundamental questions for liquidity risk management. One of the most immediate implications is around deposit stability. If customers, particularly retail and small businesses, gain access to a risk-free digital alternative to bank deposits, the potential for rapid outflows increases. Now, in a stress scenario, customers may move funds from commercial banks to CBDC wallets almost instantly, without queuing at branches or calling support. Now, this increases the risk of digital bank runs, especially if CBDCs are accessible 24/7 and perceived as safer than traditional deposits. Now, this changes the behavioral assumptions that underpin liquidity modeling. Banks will need to revisit their assumptions about deposit stickiness, customer reaction times, and stress outflow rates. Liquidity stress tests may need to incorporate new CBDC-related scenarios, such as a policy shift that increases CBDC limits, or a technology disruption that causes uncertainty in the banking system and prompts rapid flows into digital currency. At the same time, CBDCs would also enhance liquidity operations in certain ways. For For example, central banks might allow CBDC accounts for financial institutions to facilitate real-time settlement of interbank flows or securities transactions. This could improve the speed and reliability of liquidity transfers, reduce counterparty risk, and enhance intraday liquidity management. However, this would require significant updates to banking infrastructure. Treasury systems would need to be compatible with CBDC platforms. Risk models would need to reflect new payment speeds and volumes. Funding strategies would need to adapt to changes in deposit composition and velocity. And governance frameworks would need to manage the interaction between commercial bank money and central bank digital money. Now, there are also regulatory implications. Supervisors are still defining their expectations around CBDCs, and banks must engage actively in policy discussions to shape the outcomes. In the UK and EU, regulators have already begun consulting on the prudential treatment of CBDC exposures, deposit insurance, and the role of banks as intermediaries in a digital currency ecosystem. These decisions will shape the liquidity landscape for years to come. Now, beyond AI and CBDCs, another transformative trend is the move towards real-time payments and settlement systems. In many markets, payment systems are shifting from batch-based end-of-day settlement to continuous, near-instant processing. The UK's new payments architecture and Europe's target instant payment settlement, or TIPS for short, are examples of this evolution. These systems promise faster, more efficient payments for customers, but they also compress liquidity cycles for banks. Traditionally, banks had time to manage their liquidity positions throughout the day. They could rely on predictable flows, end-of-day sweeps, and overnight planning. In a real-time environment, those buffers shrink. Payments can occur at any time, from any location, and in any volume. This creates new pressure on intraday liquidity, requiring more precision, visibility, and responsiveness from Treasury teams. To manage this, banks are investing in real-time liquidity monitoring tools that track cash positions across accounts, currencies, and systems. These tools provide dashboards and alerts to ensure that payment obligations are met without overdraft or delay. Some banks are even building liquidity bots, automated agents that monitor flows and execute funding actions automatically within preset risk parameters. The shift to real-time also affects contingency planning. In a traditional model, a liquidity crisis might unfold over days or hours. In a real-time world, it could unfold in minutes. This means that contingency funding plans must be faster, more streamlined, and more automated. It also means that early warning indicators must be sharper, able to detect stress signals quickly and accurately. There are also implications for funds transfer pricing. As payment volumes increase and funding cycles shorten, banks may need to rethink how they allocate liquidity costs across business lines. FTP systems must become more granular, responsive, and reflective of intraday activity, especially for high-volume, low-margin businesses like payments and transaction banking. Now, technology is also enabling new models of liquidity sourcing and distribution. Some firms are exploring blockchain-based liquidity pools, decentralized finance platforms, and tokenized assets that can be used as collateral or funding instruments. Now, while these remain largely experimental, they point towards a future where liquidity is more programmable, composable, and transparent, though not without new risks. One overarching theme in all of these developments is the growing convergence of liquidity and technology. Treasury teams are no longer just cash managers. They are data analysts, technologists, and strategists. The systems they use must be real-time, integrated, and predictive. The decisions they make must account for new behaviors, new assets, and new speed. And the controls they operate must be fast enough to keep pace with markets that never sleep. Now, to prepare for this future, banks must act on multiple fronts. They must invest in technology, upgrading systems, hiring talent, and embedding analytics into Treasury workflows. They must engage with regulators, participating in CBDC pilots, contributing to consultations, and reshaping prudential policy. They must review and adapt their risk frameworks, modifying stress tests, FTP structures, and contingency plans to reflect new dynamics. And they must foster a culture of agility and innovation, where Treasury is empowered to experiment, learn, and lead. To summarize, the future of liquidity management will be faster, smarter, and more digital. AI, CBDCs, and real-time payments are not just incremental changes. They represent a shift in how liquidity moves, how risk emerges, and how banks must respond. The banks that succeed will be those that see these trends not as threats, but as opportunities to build resilience, improve efficiency, and lead the industry forward. In our next session, we'll dive deeper into digital transformation, exploring the evolution of Treasury stacks, data architecture, and platform integration. We'll look at how Treasury functions are modernizing their systems and processes to operate at scale, with speed, control, and transparency. I'll see you in the next session. In our previous session, we explored the evolving landscape of liquidity, how AI, central bank digital currencies, and real-time payments are reshaping how liquidity behaves and how banks must adapt. At the heart of the adaptation lies a deeper transformation, the modernization of Treasury technology. In this session, we'll explore how banks are upgrading the systems, tools, and data architectures that support liquidity risk management. We'll examine the core components of a modern Treasury tech stack, the challenges of integration and automation, and how leading firms are using technology to enhance visibility, control, and agility. By the end of this session, you'll understand how digital infrastructure underpins liquidity resilience and why getting it right is a strategic imperative. So let's begin by understanding the core problem that many banks still face: fragmented systems. In many institutions, Treasury operations rely on multiple legacy platforms, some of them developed decades ago and patched together over time. Now, these systems may not communicate well with one another. They might use inconsistent data standards and require significant manual intervention. As a result, producing an accurate, up-to-date view of the bank's liquidity position can be time-consuming, error-prone, and operationally risky. This fragmentation affects everything from cash forecasting and collateral management to regulatory reporting and FTP calculations. It creates delays in decision-making, limits stress testing capability, and increases reliance on spreadsheets and email chains. In a normal environment, these inefficiencies reduce responsiveness. In a crisis, they can threaten the bank's ability to act at speed. Now, to address this, banks are increasingly investing in Treasury technology modernization, a comprehensive effort to consolidate, automate, and upgrade the digital tools that support liquidity management. The goal is to move from a fragmented, reactive environment to an integrated, real-time, insight-driven ecosystem. Now, at the core of this transformation is the Treasury Management System. A modern Treasury management system acts as a central hub that connects front office execution, middle office risk monitoring, and back office settlement and accounting. It provides a consolidated view of cash positions, funding flows, and liquidity metrics across currencies, legal entities, and geographies. It also supports deal capture, pricing, analytics, and compliance reporting. Now, modern Treasury platforms are increasingly delivered as cloud-based solutions, offering scalability, faster upgrades, and lower infrastructure costs. They integrate with market data providers, internal systems, and regulatory platforms via APIs, enabling seamless data flow and reducing reconciliation burdens. Now, a key feature of modern Treasury technology is real-time liquidity monitoring. Now, this allows Treasury teams to see cash balances, funding gaps, intraday flows, and collateral usage as they evolve throughout the day. Dashboards provide visual summaries of key indicators such as available buffer, survival horizon, currency mismatches, and stress scenarios, alongside drill-down capability to investigate movements or anomalies. Now, these tools are especially important in the context of real-time payments and intraday liquidity risk, as we discussed in the previous session. The ability to monitor and act on positions in real time gives banks a competitive edge, not just in managing risk, but in improving customer service, reducing overdrafts, and optimizing collateral usage. Another major pillar of the Treasury tech stack is collateral management infrastructure. As secured funding becomes more central to liquidity strategy via repo markets, central bank operations, and margining agreements, banks need systems that can track, value, and allocate collateral in real time. These platforms must manage eligibility rules, haircut schedules, substitution logic, and optimization algorithms. They also need to integrate with legal documentation, counterparty exposure limits, and market data feeds. Effective collateral management reduces funding costs, enhances market access, and ensures compliance with regulatory requirements such as EMIR, SFTR, and Basel III. In times of stress, when collateral availability tightens and haircuts rise, the ability to quickly identify and mobilize assets can make the difference between resilience and disruption. Now, alongside these operational systems sits the data and reporting infrastructure. Liquidity reporting today is highly complex, especially in the UK and EU. Firms must submit detailed regulatory templates such as the PRA 110 in the UK or ALMM in the EU, often on a daily or monthly basis. Now, these reports require granular, reconciled data from across the bank's systems, loan books, deposit systems, trading platforms, and core ledgers. To support this, many banks are building central data lakes or data warehouses where information is standardized, cleansed, and stored in a consistent format. Reporting engines then pull these from central sources to produce accurate, timely outputs. Increasingly, firms are using data lineage tools to track the origin, transformation, and use of every data point, improving auditability and control. Now, the role of automation is growing rapidly. Robotic process automation, or RPA for short, is being used to eliminate repetitive manual tasks such as data collection, reconciliation, and report generation. Bots can monitor cash balances, trigger alerts, or even initiate funding actions under predefined rules. Machine learning models are also being deployed to enhance anomaly detection, flag suspicious patterns, and improve forecasting accuracy over time. Integration is another key theme. Treasury platforms must work seamlessly with risk systems, finance platforms, customer interfaces, and regulatory tools. This requires standardized APIs, shared identifiers, and enterprise-wide data governance. In many banks, this integration is supported by a Treasury data model, a blueprint that defines how liquidity-related data is structured, tagged, and shared across the organization. Some institutions are also investing in Treasury dashboards for the board and ALCO, providing visual summaries of liquidity positions, trends, stress test results, and market conditions. Now, these dashboards enable faster decision-making, more informed discussions, and clearer accountability. In a world where liquidity can shift quickly, having the right insights at the right level is critical. Security and resilience are also top priorities. Treasury systems are mission critical and must therefore be protected from cyber threats, outages, and data loss. Modern platforms incorporate multi-layered cybersecurity, disaster recovery protocols, and active-active setups that ensure continuity of service. Regulators now expect evidence of Treasury resilience planning, including simulations of operational disruption and recovery procedures. Now, it goes without saying that people and skills are an essential part of the digital transformation. As technology evolves, Treasury teams need to develop new capabilities, not just in risk and finance, but in data science, automation, and digital operations. Leading banks are investing in training, hiring tech-savvy talent, and fostering a culture of innovation within Treasury functions. Technology is also enabling new ways of working. Many Treasury teams now operate in agile squads, combining Treasury specialists, technologists, and analysts to build and iterate solutions quickly. Now, these teams work closely with business lines and risk functions, co-creating tools that solve real problems and deliver value incrementally. Now, this agile mindset helps Treasury stay responsive in a dynamic environment. Now, a powerful example of innovation is the emergence of Treasury as a service models, where core liquidity and funding tools are delivered via platforms that can be configured and scaled across business units or even outsourced functions. These models offer banks flexibility, speed, and access to best-in-class capabilities without the need for extensive internal builds. The regulatory environment is also evolving in response. Supervisors increasingly expect banks to demonstrate digital maturity in Treasury, showing that systems are integrated, controls are automated, and decisions are data-driven. In the UK, the PRA reviews Treasury technology as part of ILAAP assessments. In the EU, the EBA is encouraging banks to improve data quality, reporting automation, and model governance. Across the board, the message is clear. Digital capability is no longer optional, it's expected. To summarize, Treasury technology is becoming the backbone of liquidity management. It enables real-time insight, operational efficiency, regulatory compliance, and strategic agility. Banks that invest in their Treasury infrastructure position themselves to manage risk more effectively, allocate resources more intelligently, and respond to change more quickly. Technology is not replacing Treasury, it's empowering it to do more, faster, and better. In our next session, we'll explore liquidity governance and culture, how leadership, incentives, and organizational behavior shape liquidity outcomes. We'll look at how risk culture is built, how escalation works in practice, and how liquidity becomes part of the bank's DNA. I'll see you in the next session. So far in this course, we've explored liquidity from technical, operational, and strategic angles. We've delved into models, systems, regulatory frameworks, market instruments, and future trends. But behind all of that lies something more foundational, something less visible, but absolutely vital: the way people think, behave, and take responsibility for liquidity. In this session, we're going to focus on liquidity governance and culture. We'll look at how good governance structures ensure that liquidity is understood, prioritized, and managed consistently across the bank. And we'll look at how culture, so how people perceive risk, respond to pressure, and make decisions, shapes the effectiveness of liquidity management. By the end of this session, you'll understand that liquidity risk isn't just managed by models or metrics, it's managed by people and the choices they make every day. So let's begin with governance. In a banking context, governance refers to the structures, roles, responsibilities, and processes that guide how decisions are made and how risks are controlled. For liquidity, governance starts at the board of directors. The board is ultimately accountable for ensuring that the bank maintains sound liquidity risk management and has adequate systems and resources to do so. It must approve the liquidity risk appetite, review key metrics and reports, and challenge management where necessary. But in practice, much of the liquidity governance is delegated to committees. The most important of these is the Asset and Liability Committee, or ALCO for short. ALCO sits at the executive level and is responsible for overseeing the bank's balance sheet risks, particularly interest rate risk, funding risk, and liquidity risk. ALCO brings together senior leaders from Treasury, risk, finance, and the business. It meets regularly, often monthly, and more frequently during periods of stress. ALCO reviews liquidity positions, funding strategies, stress test results, regulatory compliance, and market developments. It sets internal liquidity targets, approves contingency funding plans, and monitors performance against the ILAAP. ALCO is also responsible for making trade-offs between risk and return, deciding, for example, whether to lengthen the funding profile at a higher cost or accept more concentration risk in deposits. These decisions must be taken with full awareness of the risk appetite and in alignment with the bank's strategy. Supporting ALCO may be more focused committees, such as the Liquidity Risk Committee, a funding strategy group, or a Treasury forum. These groups dive deeper into specific topics, such as stress testing assumptions, bond issuance plans, or internal transfer pricing structures. They allow for detailed discussion and preparation before proposals are escalated to ALCO or the board. Now, one of the most important aspects of governance is clear ownership. Every aspect of liquidity management must have a defined owner, someone who is accountable for monitoring, reporting, and acting on that risk. Treasury owns the daily liquidity position and funding execution. Risk owns the oversight of models, stress tests, and compliance with the risk appetite. Finance owns the balance sheet and cash flow data that underpin liquidity forecasts. IT own the systems that process and reconcile transactions. Internal audit provides assurance over the entire framework. Now, without this clarity of ownership, gaps appear. Issues may go unreported, decisions may be delayed, and responses may be uncoordinated. That's why many banks map their governance responsibilities using a RACI framework. So defining who is responsible, who is accountable, who is consulted, and who is informed for each process or decision. Now, this ensures that everyone knows their role and nothing falls between the cracks. Now, another key part of governance is escalation. When a liquidity issue arises, whether it's a metric breach, a market signal, or an operational incident, it must be escalated quickly, clearly, and through the right channels. Banks establish escalation procedures that define what issues must be reported, to whom, and within what time frame. For example, a breach of a liquidity early warning threshold may need to be escalated to Treasury, then to Risk, then to ALCO within 24 hours. If the issue escalates into a crisis, the liquidity contingency plan is triggered and the crisis governance structure takes over. Escalation also involves regulatory communication. If a firm breaches its LCR or expects to do so, it must notify its regulator immediately, explain the causes, and set out remediation actions. Supervisors expect firms to be transparent, timely, and proactive. Poor escalation can damage credibility and may result in more intensive supervision or even enforcement. Now, strong governance structures are essential, but they are only part of the picture. The other part is culture. Culture is the shared set of values, beliefs, and behaviors that influence how people think and act. It determines how seriously liquidity risk is taken, how responsibly decisions are made, and how actively issues are raised. A strong liquidity culture is one where liquidity is everyone's business, not just the job of Treasury or Risk. In a healthy liquidity culture, business units understand the liquidity impact of their products, pricing, and growth strategies. They consider liquidity when designing new offerings, planning for expansion, or engaging with clients. They understand that short-term profits must be weighed against the long-term funding needs. They are open to challenge, willing to escalate concerns, and supportive of central risk functions. This culture is shaped by tone from the top. When senior leaders talk about liquidity in their speeches, strategy documents, and performance reviews, it signals that this risk matters. When they ask tough questions about funding plans or stress test results, it sets expectations. When they support investments in liquidity infrastructure and resources, it sends a message about priorities. Now, culture is also shaped by training and awareness. Treasury and risk teams must invest in educating colleagues across the bank about how liquidity works, why it matters, and what their role is. This may involve workshops, e-learning modules, simulations, or internal campaigns. For example, a bank might run a liquidity war game exercise with senior management, simulating a funding crisis and testing decision-making under pressure. These activities build understanding, confidence, and capability. Incentives are another critical lever. If business units are rewarded purely on revenue or loan growth without consideration for liquidity usage or funding cost, they may take actions that harm the bank's liquidity profile. That's why many banks embed liquidity into performance management and pricing frameworks. Funds transfer pricing charges ensure that liquidity usage is priced in. Balanced scorecards may include liquidity metrics. Capital and liquidity usage may be factored into bonus pools. The message is simple. What gets measured and rewarded gets managed. Now, a strong liquidity culture also means healthy challenge. Treasury and risk must feel empowered to challenge business decisions that create liquidity risks. Business units must feel comfortable raising concerns or questioning assumptions. Governance forums must encourage debate, not just rubber stamp decisions. Internal audit must be respected and resourced to provide independent assurance. Regulators increasingly assess this culture during supervisory reviews, looking for evidence of engagement, responsiveness, and openness. Now, one area where culture plays out visibly is in crisis simulations and dry runs. These exercises reveal how teams behave under pressure, how well they communicate, how quickly they escalate, how clearly they document, and how effectively they coordinate. Postmortems from these exercises are incredibly valuable for identifying cultural strengths and weaknesses. For example, did anyone hesitate to speak up? Were decisions made collaboratively or in silos? Did people rely on email or pick up the phone? Many banks use these insights to inform their training, governance structures, and even organizational design. Some have established liquidity command centers, cross-functional teams trained to operate in crisis mode with clear playbooks, decision trees, and communication protocols. Now, these teams can be activated quickly during a real stress event and have the trust of senior leadership to act decisively. Now, culture is also influenced by external expectations. Regulators are placing more emphasis on the non-quantitative aspects of risk management: governance, conduct, and culture. In the UK, the Senior Managers and Certification regime places personal accountability on senior leaders for risk outcomes, including liquidity. In the EU, guidelines on internal governance require firms to demonstrate effective risk cultures. Now, this regulatory focus reinforces the need for banks to embed liquidity awareness not just in systems and models, but in people and practices. And let's not forget the role of diversity and inclusion in liquidity governance and culture. Diverse teams bring broader perspectives, richer discussions, and better decisions. In a complex, fast-moving environment like liquidity risk, these qualities are invaluable. Inclusive cultures also support psychological safety, where people feel safe to speak up, challenge assumptions, and admit mistakes. Now, these behaviours are not just good for morale, they're essential for risk management. To summarise, effective liquidity risk management depends as much on people as it does on policies or models. Governance provides the structure: clear roles, strong oversight, and well-defined processes. Culture brings it to life through values, behaviours, and daily decisions. When governance and culture are aligned, banks manage liquidity more proactively, respond to stress more effectively, and earn greater trust from regulators and the markets. In our next session, we'll explore the relationship between liquidity and capital, two of the most critical buffers in banking. We'll examine how they interact, where they differ, and how they are planned and managed together to build overall resilience. I'll see you in the next session. In the last session, we explored the governance and culture that underpin effective liquidity risk management, emphasizing that processes and systems must be matched by clarity, responsibility, and risk-aware behaviors. Now we turn to another essential relationship in the banking system, the one between liquidity and capital. Now, these two concepts, distinct but deeply connected, form the twin pillars of financial resilience. In this session, we'll explore how liquidity and capital interact, how they differ in purpose and behaviour, and how banks manage them together as part of an integrated balance sheet strategy. We'll also look at regulatory expectations, capital liquidity trade-offs, and the lessons learnt from past crises. By the end of this session, you'll understand why liquidity and capital are not just separate risk categories, but two sides of the same resilience coin. So let's begin in defining the difference. Capital is the cushion that protects a bank from insolvency. It absorbs losses when asset values fall or when the bank's business model underperforms. It reflects the bank's ability to remain solvent, meet regulatory thresholds, and continue operating as a going concern. Liquidity, on the other hand, is about survival, specifically the bank's ability to meet its cash obligations as they fall due in the short term. It's not about losses, it's about flows. A bank can be well capitalised and still fail if it runs out of liquidity. Now, likewise, a bank can be liquid in the short term, but fundamentally undercapitalised, leading to an eventual solvency crisis. Now, this distinction is critical, especially in stress events. Consider what happened during the global financial crisis. Some banks that appeared strong on capital, thanks to large equity cushions or retained earnings, still collapsed or required emergency support because they couldn't access short-term funding. Their assets were illiquid, their counterparties pulled away, and their buffers were either unusable or insufficient. Liquidity crises often unfold faster than capital crises. They can emerge in hours or days rather than months or years. But while capital and liquidity are different in purpose, they are deeply connected in practice. One of the most important connections is confidence. Market participants and depositors care about both liquidity and solvency. If a bank is seen as undercapitalised, it may suffer a liquidity run as counterparties withdraw funding or clients move deposits. Conversely, if a bank is seen as illiquid, it may be assumed to be in trouble, prompting credit downgrades or equity sell-offs that erode capital. Now, this is known as the feedback loop between capital and liquidity, and it can be both rapid and reinforcing. This is why regulators require banks to manage both dimensions together. Under the Basel III framework, banks must maintain a minimum common equity Tier 1 capital ratio to absorb losses, as well as meet LCR and NSFR thresholds to ensure liquidity resilience. In the UK, the PRA also expects banks to assess both capital and liquidity adequacy through ICAAP, which is the Internal Capital Adequacy Assessment Process, and ILAAP, the Internal Liquidity Adequacy Assessment Process. Now, these assessments are reviewed jointly by supervisors during the Supervisory Review and Evaluation Process, SREP. Now, in practice, ICAAP and ILAAP must be aligned. That means the assumptions used in capital planning, such as revenue forecasts, loan losses, or market stress scenarios, must be consistent with those used in liquidity planning. For example, if the ICAAP assumes a 20% drop in mortgage valuations, the ILAAP must consider how that might affect the liquidity value of mortgage-backed securities. If the ICAAP includes a severe earnings shock, the ILAAP must consider the knock-on effects on funding access or buffer usability. Banks must also consider capital liquidity trade-offs. For instance, holding more capital can improve market confidence and reduce funding costs, enhancing liquidity indirectly. But raising capital can also be expensive or dilutive, especially in times of stress. Similarly, increasing the liquidity buffer improves short-term survival, but often at the expense of profitability, as high-quality liquid assets typically yield less than loans or securities. Now, Treasury and finance teams must balance these considerations when planning the balance sheet, managing investor relations, and allocating internal resources. Funds transfer pricing plays a key role here, as we discussed in earlier sessions. FTP allocates both liquidity and capital costs to business units, helping to ensure that lending, deposit taking, and trading activities reflect their true economic impact. A loan with high capital requirements but low liquidity risk will have a different FTP than one with the opposite profile. Now, this pricing helps business units optimize product design, client selection, and growth strategies in line with risk appetite. Another connection between capital and liquidity is in stress testing. Banks must run integrated stress scenarios that show how capital and liquidity positions evolve together. For example, a downturn scenario might reduce income, increase credit losses, and cause capital ratios to fall. At the same time, funding markets may tighten, LCR may decline, and the survival horizon may shorten. Banks must demonstrate that they can survive these combined stresses without breaching thresholds or needing extra support. The integrated stress testing is increasingly expected by regulators. In the UK, the PRA reviews stress tests as part of the SREP and expects consistency between ICAAP and ILAAP. In the EU, the ECB's liquidity stress testing guidelines also call for alignment with capital scenarios. Some banks have begun using consolidated dashboards that show both capital and liquidity under various scenarios, providing ALCO and the board with a holistic view of resilience. Now, recovery and resolution planning also brings capital and liquidity together. A good recovery plan identifies options for restoring both capital and liquidity, such as selling assets, issuing equity, or reducing risk-weighted assets. These options must be assessed for feasibility, timing, and effectiveness under stress. For example, selling a business line may improve capital but worsen liquidity if it triggers outflows or requires cash upfront. Similarly, issuing debt may improve liquidity metrics but raise capital costs if spreads widen. Resolution planning, particularly for global systemic banks, requires careful coordination of capital and liquidity resources. Regulators assess whether the group can be resolved in an orderly way without taxpayer support. Now, this includes ensuring that enough loss-absorbing capacity, or TLAC for short, is available to recapitalize entities and that sufficient pre-position liquidity exists to support critical operations. The Bank of England's Resolvability Assessment Framework, known as RAF, and the ECB's Banking Union Resolution Planning both emphasise the need for alignment across capital and liquidity pillars. One area where capital and liquidity intersect closely is in contingency funding actions. For example, in a stress scenario, a bank may plan to raise capital to restore confidence, but doing so may signal weakness, triggering liquidity outflows. Or the bank may plan to draw on a central bank facility, improving liquidity, but possibly promoting a ratings downgrade that affects capital markets access. Now, these interdependencies must be carefully modelled, sequenced, and communicated. From an investor perspective, capital and liquidity are often viewed together. Credit rating agencies assess both when assigning ratings. Equity analysts consider both when valuing banks. Bond investors look at both to assess creditworthiness. For this reason, banks must manage external communication around capital and liquidity in a coordinated way, ensuring consistency, transparency, and credibility. Internally, the Treasury, finance, and risk functions must work together to coordinate capital and liquidity planning. Treasury manages funding and liquidity buffers. Finance models earnings, dividends, and capital forecasts. Risk oversees stress testing, capital models, and liquidity frameworks. These teams must share data, align assumptions, and co-own decisions. In many banks, this coordination is achieved through joint planning forums, shared systems, and cross-functional teams. Now, technology plays a growing role here. Leading firms are building integrated balance sheet management platforms where capital, liquidity, and interest rate risk are modelled together. These systems allow banks to simulate strategic decisions such as asset growth, capital issuance, or buffer optimization, and assess their impact on all key metrics. This supports better decisions, faster responses, and more effective communication with regulators and investors. It's also worth noting that capital and liquidity planning must consider longer-term risks, including climate risk, geopolitical shocks, and digital disruption. These risks may affect both solvency and funding through changes in asset values, income volatility, or investor sentiment. Scenario planning and strategic foresight are becoming essential tools in connecting the capital liquidity landscape to future uncertainty. To summarise, liquidity and capital are different but interdependent. One protects against insolvency, the other against illiquidity. Both are essential to survival and both must be managed collectively. Banks that take an integrated approach, aligning plans, coordinating teams, and connecting assumptions, are better equipped to weather stress, meet regulatory expectations, and sustain long-term success. In our next session, we'll explore how liquidity risk management interacts with climate risk and ESG. We'll examine how environmental trends and sustainability objectives are reshaping funding models, investor expectations, and regulatory frameworks. I'll see you in the next session. Throughout this course, we've looked at liquidity risk as a financial, operational, and regulatory challenge. We've explored how banks manage their funding, buffers, systems, and governance to remain resilient in the face of shocks. But today, liquidity management must also respond to a broader agenda, one that reaches beyond traditional risk categories and into the environmental and social fabric of the financial system. In this session, we're going to explore how climate risk and environmental, social, and governance factors are beginning to shape the way liquidity is managed, assessed, and reported. We'll examine how sustainability trends affect funding models, how regulators and investors are adapting their expectations, and how banks can prepare for a future where ESG and liquidity risk are increasingly interwoven. By the end of this session, you'll see how climate and liquidity risks are no longer separate silos, they are part of the same forward-looking conversation about resilience and responsibility. So let's begin with the concept of climate risk and how it's traditionally viewed in financial institutions. Now, broadly speaking, climate risk falls into two categories: physical risk and transition risk. Physical risk refers to the direct impact of climate events, such as floods, wildfires, or storms, on assets, infrastructure, and business continuity. Transition risk refers to the indirect impact of shifting to a low-carbon economy, such as changes in policy, regulation, technology, or consumer preferences that affect the value or performance of assets. Now, until recently, these risks were seen mainly through a credit risk lens. For example, a bank might assess whether a coastal property is at higher risk of flooding, or whether a loan to a coal-fired power plant faces reputational or policy pressure. But increasingly, climate risk is being recognised as a liquidity risk too. The connection lies in how markets react, how funding flows respond, and how investor behaviour shifts in response to climate-related events or information. Now, one way this shows up is in funding volatility. If a bank has a high exposure to carbon-intensive sectors or is seen as lagging on ESG commitments, it may face reduced access to wholesale funding or investor pullback. Green-focused investors may divest. ESG index providers may downgrade. Certain money market funds or central banks may restrict eligibility for collateral or investment. All of these actions can create outflows or reduce funding capacity, introducing liquidity strain even when the bank's core credit position remains unchanged. Now, conversely, banks that demonstrate strong ESG credentials may benefit from cheaper and more stable funding. They may be able to issue green bonds at tighter spreads, access new investor pools, or benefit from preferential regulatory treatment. For example, the European Central Bank has begun integrating climate criteria into its asset purchase and collateral frameworks. The Bank of England is exploring similar approaches. Now, these developments are changing the economics of liquidity, where ESG performance increasingly affects funding cost, investor confidence, and regulatory access. Another connection between ESG and liquidity is the use of proceeds model. In recent years, many banks have begun issuing green, social, or sustainability-linked bonds. These instruments raise funds earmarked for projects that meet specific ESG criteria, such as renewable energy, affordable housing, or energy-efficient buildings. From a liquidity perspective, these bonds provide term funding that supports NSFR compliance. They may also be eligible as HQLA, depending on the jurisdiction and structure. But issuing ESG-labelled bonds comes with additional requirements. Banks must have robust frameworks for project selection, impact reporting, and assurance. Treasury teams must coordinate with sustainability functions to ensure that funding aligns with strategy and that disclosures meet investor expectations. If credibility is lost, for example through greenwashing or inconsistent reporting, it can harm reputation, restrict access to ESG capital markets, and increase liquidity risk. ESG factors are also beginning to shape counterparty and customer behaviour, which in turn affects liquidity flows. For example, corporate clients may shift their banking relationships to institutions that align more closely with their sustainability goals. Pension funds may impose ESG screening on their deposit placements or repo counterparties. Asset managers may require ESG scoring as part of their counterparty due diligence. Now, these behaviours can shift funding patterns and create new forms of liquidity concentration risk if not monitored. Now, on the regulatory side, climate-related expectations are accelerating. The Task Force on Climate-Related Financial Disclosures framework is being adopted globally as a baseline for reporting climate risk exposure, governance, strategy, and metrics. In the UK, the TCFD-aligned disclosures are mandatory for large banks, and the PRA has issued detailed guidance on how firms should embed climate risk into governance, risk management, and scenario analysis. Now, while current regulation doesn't prescribe specific liquidity treatments for climate risk, supervisory expectations are evolving. For example, the PRA's Climate Supervisory Statement, SS319, encourages firms to assess the materiality of climate risk across all risk types, including liquidity. This means firms should consider how climate-related events or transitions could affect funding markets, customer behaviour, buffer usability, or market access. Some supervisors have also begun conducting climate stress tests. The Bank of England's 2021 Climate Biennial Exploratory Scenario required participating firms to assess the financial impact of different climate pathways over a 30-year horizon. Now, while the focus was on credit and market risk, many firms used the exercise to explore potential liquidity implications, such as changes in deposit flows, asset liquidity, or funding spreads. In the EU, the ECB has launched similar initiatives with plans to expand the scope to include short-term market shocks. Now, looking ahead, we may see the development of climate-specific liquidity stress scenarios. These could include events such as abrupt policy shifts, like a sudden increase in carbon taxes, or physical climate events that disrupt financial markets. For example, a major flood or wildfire could affect operational continuity, increase claims on insurance providers, and reduce market confidence, triggering funding pressures. Now, these scenarios require new data, new modelling techniques, and cross-functional collaboration between Treasury, risk, and sustainability teams. Another emerging concept is ESG-adjusted collateral frameworks. Central banks and clearinghouses are exploring whether to adjust eligibility or haircuts based on the climate risk of pledged assets. For instance, sovereign bonds from countries lagging in climate action could face higher haircuts, while green assets may receive preferential treatment. These changes could affect the usability of liquidity buffers and the availability of secured funding, making ESG performance a factor in day-to-day liquidity management. Internally, banks must begin to integrate ESG into liquidity governance and strategy. This includes assessing the ESG profile of funding sources, counterparties, and assets. It also means embedding sustainability into product design, transfer pricing, and funding allocation. Some firms are developing ESG-linked FTP curves where sustainable business lines receive lower internal funding charges or where liquidity premiums reflect ESG risk. Now, while still evolving, these approaches aim to align financial incentives with long-term sustainability goals. Now, culture plays a role here too. As we discussed in our previous session, a strong liquidity culture values transparency, responsibility, and long-term thinking. These values are equally essential for ESG integration. Treasury and risk teams must be part of the bank's sustainability journey, not just as compliance partners, but as strategic contributors. They bring the data, the discipline, and the scenario thinking that ESG frameworks increasingly require. And technology is also an enabler. ESG data platforms, climate analytics tools, and integrated risk systems allow banks to map exposures, simulate outcomes, and produce disclosures more effectively. Treasury teams are using these tools to model the liquidity impact of ESG trends, such as investor shifts, market sentiment, or policy changes. They are also using them to identify green funding opportunities and align reporting with global standards. To summarise, climate and ESG trends are reshaping the liquidity landscape. They influence funding availability, buffer usability, investor behaviour, and regulatory scrutiny. Banks that understand and respond to these dynamics are better positioned to manage risk, attract capital, and lead the transition to a more sustainable financial system. Liquidity risk management is no longer just about cash and credit. It's about credibility, commitment, and contribution to a greener future. In our final session, we'll bring everything together. We'll reflect on the full liquidity risk framework, draw connections across the course, and look at what it means to be a future-ready liquidity professional. We'll conclude our journey with a roadmap for embedding best practice in an ever-changing world. I'll see you in the next session. Now, it goes without saying that we've covered a lot of ground in this course, from foundational concepts to regulatory expectations, from daily operations to strategic planning, and from historic crisis to future-facing technologies. We've explored liquidity risk management in banking from every angle. And now, in our final session, it's time to bring it all together. In this session, we'll take a step back and reflect on what we've learned. We'll identify the core principles that underpin strong liquidity management, highlight the skills and mindsets required of today's liquidity professionals, and set out a roadmap for continuous improvement in a world that never stands still. By the end of this session, you'll have a complete view of what it means to manage liquidity risk with integrity, confidence, and strategic foresight. So let's begin by summarizing the framework we've built. At the core of liquidity risk management is the ability to meet obligations as they fall due in all conditions without relying on extraordinary support. Now, this simple definition has many layers, from calculating cash flows and managing buffers to understanding funding markets and responding to stress. We've seen that liquidity is both quantitative and qualitative. Metrics like the liquidity coverage ratio and the net stable funding ratio provide important benchmarks, but compliance alone isn't enough. Banks must understand their own liquidity profile, how funding behaves, how assets can be monetized, and how decisions made in one part of the organization affect the whole. They must use stress testing, contingency planning, and behavioral analysis to go beyond the numbers and prepare for the unknown. We've explored how liquidity must be managed at different time horizons. Intraday to support payment flows and operational continuity, short-term to manage outflows and maintain buffers, medium and long-term to align funding with strategy, business growth, and regulatory expectations. Each horizon brings different risks, tools, and governance requirements. We've examined the structure and function of Treasury, the nerve center of liquidity. We've seen how Treasury interacts with markets, manages funding, prices liquidity internally, and operates under both normal and stress conditions. We've also looked at the critical role of risk and finance and the need for coordination across functions, legal entities, and jurisdictions. We've seen how liquidity is a regulatory priority, with detailed expectations across the UK, EU, and global frameworks. From ILAAPs and PRA 110 returns to stress testing and recovery plans. Supervisors require banks to demonstrate control, resilience, and foresight. We've discussed the importance of alignment between ICAP and ILAAP and the growing emphasis on governance, culture, and data integrity. We've explored the tools banks use to manage liquidity. Funds transfer pricing to allocate cost and drive behaviour. Contingency funding plans to prepare for stress, liquidity forecasts to anticipate change, collateral platforms to unlock funding, dashboards to provide visibility, and increasingly, we've seen how technology through AI, automation, and real-time infrastructure is enabling smarter, faster, and more integrated decision-making. We've examined the complexity of operating in a cross-border world where liquidity is not always fungible. We've looked at ring fencing, currency mismatches, and the importance of local buffers and intra-group support. And we've recognised the importance of systems, communication, and governance in maintaining group-wide resilience. In recent sessions, we've looked ahead to the impact of CBDCs, real-time payments, climate risk, and ESG expectations. We've seen how the future of liquidity will be shaped by technology, sustainability, and policy shifts. And we've discussed how Treasury and risk functions must evolve, not just to keep up, but to lead. So where does this all leave us? What does it mean to be a liquidity professional today? Well, first and foremost, it means embracing a multidisciplinary mindset. Liquidity isn't just about funding or finance. It's about strategy, systems, people, regulation, and markets. The best liquidity professionals are curious, collaborative, and commercially aware. They understand the details, metrics, models, and mechanisms, but never lose sight of the bigger picture. It also means becoming fluent in data and digital tools, whether you're building forecasts, analysing stress results, or explaining buffer movements to a regulator. You'll need to work with complex data and increasingly to do so in real time. Understanding how data flows, how models operate, and how systems interconnect is no longer the job of someone else. It's part of the core skill set. Being a liquidity professional also means becoming a strong communicator. Liquidity issues often emerge in high-pressure situations where decisions must be made quickly and clearly. Whether you're speaking to ALCO, reporting to the board, or briefing a regulator, your ability to translate technical issues into business terms will shape how decisions are made and how risk is managed. It also means embracing a risk culture that values challenge, transparency, and accountability. Liquidity risk can be subtle. It often sits just beneath the surface until it doesn't. Being willing to speak up, escalate concerns, and test assumptions is part of your role. So is helping others across the bank understand liquidity and how their decisions affect it. And finally, being a liquidity professional means thinking long term. Liquidity is about more than daily cash balances. It's about trust. Trust from clients that their money is safe. Trust from regulators that your firm is well managed. Trust from investors that you can honour your obligations. Building that trust requires planning, preparation, and a mindset of continuous improvement. So what should you do next? If you're just starting out in Treasury or risk, take the time to build your foundational knowledge. Learn the language of liquidity. Understand how funding works. Get familiar with your bank's policies, metrics, and systems. Ask questions. Read reports. Sit in on ALCO meetings if you can. If you're more experienced, look for ways to enhance integration. How well do Treasury, risk, and finance work together? Are your models consistent? Are assumptions aligned? Can your stress scenarios be improved? Look at your FTP framework. Does it reflect current market conditions and strategic goals? If you're in leadership, think about culture and resilience. Is liquidity prioritized across the organization? Are contingency plans understood and rehearsed? Are the right people empowered to act during a crisis? Are your teams ready for real-time liquidity management, for ESG-linked funding, for the expectations of tomorrow? And for everyone involved in liquidity, keep learning. This field is evolving, and it's evolving fast. Regulatory priorities shift, technology advances, market structures change. Staying ahead means staying curious. It means benchmarking, networking, testing ideas, and reflecting on lessons from the past. And as we conclude this course, remember this: liquidity risk management is not about avoiding risk entirely. It's about understanding it, preparing for it, and responding with discipline and agility. It's about balancing confidence with caution, opportunity with responsibility. And it's about recognizing that in a world of complexity, the ability to act calmly, wisely, and decisively is what defines a great liquidity professional. Thank you so much for joining me on this journey. Whether you work in Treasury, risk, finance, regulation, or beyond, I hope this course has equipped you with the insights, tools, and mindset needed to manage liquidity in a dynamic global banking environment. You now have a framework to guide your next steps. So all that leaves me to say is all the best with your continued learning in the world of liquidity. Stay informed, stay engaged, and I hope to see you inside another Industry Portal course in the not too distant future.